Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Diane King Hall in for Brad Smith. And here are three things you need to know this morning. Bank of America beating the street with results this morning, but the report offering some mixed signs for investors. Profits jumped 19% year over year in the second quarter to $7.4 billion. That's 88 cents a share and ahead of forecast. B of A's net interest income rose by 14%. That met expectations, missed some expectations at $14.29 billion. It does, though, fall short of JP Morgan's 44% jump in that figure last week, something investors will be no doubt watching. Like JPM and Wells Fargo, its bottom line got a boost from higher rates. Revenue of $25.2 billion is ahead of targets. Brian Moynihan, CEO, calls it one of the strongest quarters in the company's history. And don't miss our interview with Bank of America's chief from 3 p.m. Eastern. A trading slowdown and severance costs weighing on Morgan Stanley's numbers. Profits declined 13% there with EPS at $1.24 a share. Net interest income also underwhelmed at just over $2 billion. Morgan Stanley's large wealth management arm continues to deliver the goods. However, net revenue there jumping by 16%. And then the big picture and big backdrop here is that CEO James Gorman is on his way out, but the Wall Street titan has yet to choose a successor. And retail sales in the U.S. were slower in June from the prior month, despite signs of easing price pressures. The data showed a 0.2% rise over May, below the 0.5% expected. Autos were seen as a key component of the release, but excluding that sector, the increase also missed estimates at 0.2%. The numbers are pivotal for Fed policy. A hike at this month's meeting is all but baked in. The idea that it could be one more than done is perhaps growing.
Bank of America beating the street with results this morning. Profit jumped 19% year over year in the second quarter to $7.4 billion, or 88 cents a share. That's ahead of forecast. Expectation was 84 cents a share. Now, B of A's net interest income also rising 14% to meet expectations at $14.2 billion. But it indeed falls short of JP Morgan's 44% jump last week. Now, Brian Moynihan calls it, quote, one of the strongest quarters in the company's history. Of course, don't miss our interview with Bank of America CEO at 3 p.m. Eastern time. Joining us for analysis on the quarterly results, we have Dick Beauvais, Odeon Capital Group financial strategist. Dick, thanks so much for joining us once again. So let's jump right into the results from Bank of America today. It was a beat. You had an initial pop in terms of in the pre-market. In response to its earnings. It's cooled a bit as they handle their earnings call. What's your first takeaway?
Well, I think that what you're seeing is that on a year-over-year basis, the numbers look pretty good. But on a quarter-over-quarter basis, it shows that there is some weakness developing. And I think that's traditional. Well, I shouldn't say traditional. I think that's similar to what other banks are showing in the quarter. In other words, what we're seeing is if you're solely in the banking business, PNC, for example, you're not doing particularly well. If you have a big capital markets operation to assist you, and we'll say, JP Morgan or, a company like, Wells Fargo, what you're seeing is some strength in that area. So I'd say that what Bank of America is doing at the present time is showing those trends. The banking industry weakened, the banking business weakened in the quarter-over-quarter results, and they were surprisingly strong in the capital markets arena. And I think if you're looking forward for banking, again, you have to make your call on whether there's going to be a recession or not. But if you're looking forward, I think that the trends that you're likely to see are similar to what we saw in this quarter. I think that you're going to see capital markets activity being very strong over the next few quarters. You're going to see banking being lackluster. You'll see some little pickup maybe in commercial industrial lending, but, home mortgages should be flat, and you should see, credit card lending, which was extremely strong, coming down somewhat as people are borrowing a little bit too much right now for their income.
Yeah, we did see an increase in credit card write-offs for Bank of America, although it's still well below where it was even pre-pandemic, which is interesting. Something else that stuck out to me, Dick, is consumer unit deposits, which were down 1% quarter over quarter. On a relative basis on that front, how is Bank of America doing versus its competitors?
Well, again, JP Morgan's numbers are all messed up because of the acquisition of First Republic. If you took the First Republic numbers out of JP Morgan, okay, you would see that JP Morgan's, if you will, organic numbers were down across the board. So I know people get very enthused about the JP Morgan numbers, but they tend to forget that they're not as a result of organic growth at JP Morgan. They're the result of a major acquisition, which gave them $2.7 billion in profits. All right, so if you take a look at the deposits at JP Morgan, you take a look at the deposits at Wells Fargo, if you take a look at the deposits at Bank of America, they're all feeling the same stress, and they're feeling that stress for a very logical reason. The banks are cheating the depositors. I mean, basically, the banks got this huge windfall gain as a result of something that they had nothing to do with. The Fed increased interest rates, and they didn't pass it along to their depositors. So the result is that on a deposit basis, even the big banks are showing declines in deposits, despite this theory that everybody's taking money out of the regional banks and putting it into the big banks. I'm not seeing that. Although PNC's deposit numbers were not particularly good at all in this quarter. I think that, if the banks want these deposits back, it's easy to get them back. All they have to do is raise their rates to closer to a market rate. They are reluctant to do that, however, because their margins are not doing well. So, they're in a box. They're in a box because, the yield on their assets are not enough to allow them to pay market rates on deposits. So they don't pay market rates on deposits, and the deposits go to money market funds or other areas, but they don't stay in these banks.
In their earnings report, net charge-offs increased to 869 million. So it's up from a year ago. And total loan loss levels are at 602 million. Is that concerning at all for you, for Bank of America, Dick?
Yes, it is. I think that what you're going to see is, a very, very significant increase in loan losses in the consumer sector over the next couple of quarters. I can give you a simple example, which tends to bring to bearing what I'm talking about. One of my friends called me the other day and said that he bought a car 3 years ago for $63,000. The book value of that car, the blue book value of that car today is $36,000, but the size of his loan is $45,000, and he's got 4 years to go in paying for that loan. If you multiply him by hundreds of thousands of auto buyers over the last, 3 years, you'll find that they're in a similar situation because used car prices are coming down, and they took these 6 and 7 year loans outstanding, and that is going to hit them hard. And not every one of them is going to pay, continue to make the auto payment. And if unemployment were to rise at all, then you would see a substantial increase. The same deal is going on with credit cards. People, got this huge largesse in terms of all of this money dumped into their pocket by the government, a few years ago. That money has now been spent, and so now they're borrowing, and they're not borrowing on necessities. They're borrowing on tourism, on homes outside the house, on a variety of recreational products. So, I think the consumer is in a very vulnerable position, and I think that loan losses will increase substantially, as I said a minute ago, over the next few quarters.
And Dick, just finally, quickly want to ask you about Morgan Stanley on the other side of the spectrum, the non-consumer bank side of the spectrum, because there too, even though at some of its competitors, trading operations were a little bit stronger, Morgan Stanley's results were kind of middling, I guess. Is that your assessment?
Yeah, they disappointed me because I raised the rating on Morgan Stanley last Thursday, expecting that they would show much stronger results in investment banking and better trading. I realized that trading would not be good because it just hadn't been good for anyone except for Bank of America. And I realized that the first 2 months of the quarter were not great in investment banking, but June was so strong in terms of a massive increase in M&A activity and in equity offerings that I thought Morgan Stanley would do much better than it has. So I'm kind of disappointed by those results.
Dick, it's good to see you. Dick Beauvais, Odeon Capital Group financial strategist. And on the topic of financials and of Bank of America, stay tuned for our 3 to 5 p.m. show. Our executive editor, Brian Sozzi, is going to be speaking with Bank of America CEO Brian Moynihan on the back of those earnings. You don't want to miss that. Let's stay with the financials now, speak a little bit more broadly now, and get some reaction with our guest host for this first half hour, Liz Young, SoFi's head of investment strategy. Liz, it's good to see you. Thanks for being here in person.
Wonderful to be here.
As we were saying before the show, it has been a long time, so it's fantastic to see you. So financials, out of the gate, you know, Bank of America and Morgan Stanley today, not quite as strong, but overall, it feels like there has been strength there.
Yeah.
What can we sort of extrapolate out from that?
Well, first of all, financials usually kick off earnings season. They set the tone. Everybody sort of waits with bated breath to see what the CEOs are going to say. And financials do have a really good lens, particularly the big financials, a really good lens into what the consumer is doing. So not only if the consumer is spending, but if the consumer is still borrowing. So what I heard, generally speaking, from them is that absolutely there's still an appetite to spend. It's still happening. However, there are consumers that are doing it on leverage or on credit. And so far, that is perfectly fine because everybody is still employed in a strong labor market and there's been wage growth. We see real wage growth actually coming back, which is also great. But at some point, right, if that credit gets extended, that's when you start to get concerned. But right now, everything sounds like it's still going well. Obviously, the consumer is a huge part of the U.S. economy. There is no such thing as an economic expansion without the consumer. So if they're spending, that's positive, and I think earnings season has been off to a good start with the financials.
But was the bar already kind of set low, especially like, you know, we just heard when you talk about Bank of America, sure, they beat, but they still, it was lower than quarter over quarter from its previous quarter. And was there anything concerning in the financials, in the financial sector for you?
Well, of course, the bar, yes, the bar is absolutely still low. The bar is pretty low across the board, and we're expecting negative 7% growth. That's what consensus expectations are for this quarter. So it's not that difficult to leap over a negative 7% number, right? So yes, it's true that the expectations are kind of not impressive, I guess. Concerns in the financials, I think there are a lot of risks that we already know. So obviously we know what happened in March. We saw this sort of mini or medium-sized financial crisis in the regional banks. We know that that still lurks out there, maybe an issue. There are some data points that we got already from CEOs saying that deposit growth was down. Now, that could either be an indication that things are getting weaker, or it's just a rational investor behavior thing where you've got treasuries offering a good yield, you've got money markets offering a good yield, rational investors, rational depositors would take their money and go get the higher yield. So if at some point rates do fall and money markets and treasuries stop offering that kind of rate, people will put their money back in deposits, right? So this could just be kind of a transient move of money away from deposits that are not offering a good yield. So that is one of the concerns that is starting to bubble up to the top. And then you've got basically yield curve inversions. I talk about them so often. Anybody who asks me questions is like, oh my God, when is she going to come off this yield curve inversion thing? I'm not going to until it goes away, right? But you've got these curve inversions that are warning, usually what they warn is that you've got some kind of financial stress that's coming. Well, we saw some financial stress in March, but they usually also warn that there could be a credit deterioration coming, and that we haven't really seen yet. So this growth in credit card spending, this growth in leverage on the consumer does open up the possibility and increase the risk that credit deterioration would hit a little bit harder.
I want to come back to yield inversions, but we're going to put a pause on it for right now because it's the question on many investors' minds, is the rally here to stay? We had cooler inflation data, we have a lower volatility index that have only amplified the market's upward trend as of late. But with valuations setting expectations high as earnings season gets underway, how durable is the rally's staying power? Liz, how durable is the rally's staying power?
Well, look, again, anybody who has heard me talk knows that I've been skeptical of this rally all the way up, and it has not felt great to be skeptical all the way up. At this point, you have to look at fundamentals, you have to look at valuations. And yes, I think there are parts of the market that are maybe trading at reasonable levels if we do not see a recession. And that continues to be the looming big question, right? Will we actually see a contraction that hurts those valuations? If you look at just broad valuations on the S&P 500, we are currently above the 5-year, the 10-year, and the 15-year average. So that almost screams overvalued, or at least that some sort of a healthy pullback to get us back in line with even short-term averages might be due. The other thing is, if you look at where valuations are in certain comparisons to the 10-year yield. So when the 10-year yield is usually this high, I mean, the way that the relationship should work, or the way that it usually works, is that as the 10-year yield rises, valuations come down because your discount rate went up and it became more expensive to get capital. That recently has not been the case. That relationship has completely fallen apart and said it doesn't matter anymore, and you've got stock valuations rising as yields were rising. So it doesn't necessarily mean that one or the other has to happen. It doesn't mean that stocks have to come down. But what I would say is that divergences like that, and when relationships like that stop working the way that they normally do in the short term, that doesn't last forever. So you're going to see some of those divergences close, whether that means yields have to come down or stocks have to come down. Something has to happen to get that middle ground a little bit more narrow.
So does it matter anymore? Because some would say, no, it doesn't matter because there's been a breakdown in that relationship.
Right. Yeah. And, you know, I obviously have learned things from textbooks and I've learned things from the CFA program. And there are times that I look back at some of that, or I think back on it and say, what am I missing, right? Because all of this tells me that there's still these big warning signs out there. I do think it matters, but not a lot of things that make sense in the long term are going to matter in the short term. And right now, we've got an economy, and things do change over time. I will not be the one to say it's different this time, because I don't generally believe that the economic cycle is ever all that different. But the catalysts change. And the economy that we live in today versus the economy that we lived in 15 to 20 years ago may be a little less interest rate sensitive. So when you're looking at technology stocks that are just generally more expensive than the rest of the market because you're buying growth. Now, they're interest rate sensitive in the sense of what happened in 2022, but this enthusiasm over AI and enthusiasm over just innovation that's going to occur and how much they make up of the economy hasn't seemed to care as much about interest rates. So there are some changes that have happened for sure that have made us less interest rate sensitive. There's also obviously monetary policy that is much different today than it was 15 to 20 years ago. And just this kind of expectation that we will be saved even if something bad goes wrong. And that's not necessarily a wrong expectation. It has happened every single time over recent history.
Let's come back to the yield curve now,
Sure.
to zero in on it a little bit more, because one of the folks who's sort of saying this time is different is Jan Hatzius over at Goldman Sachs, who is not necessarily the person you would expect to be saying that. He's the chief economist over there. This morning, the bank is cutting its recession probability for the next 12 months to 20% from 25%. And saying that the yield curve this time isn't necessarily 100% signaling that recession. Now, he gives a lot of different reasons, including talking about the sort of premium that people are paying on debt now versus what they were historically, which gets a little wonky. But what do you make of that sort of thinking that things could be different?
Again, you know, the catalyst is always different. The thing that gets us there is always different. But the way that we move through a cycle, so early, mid, late recession, right? That's basically the big pieces of an economic cycle. You have to reset the business cycle at some point. So some of if we were going to sit down and have a debate, if Jan and I were going to sit down and have a debate, right? I think probably part of it would be that he maybe thinks we're in a different part of the cycle, maybe an earlier part of the cycle. I'm putting words in his mouth, and I don't mean to do that. But if he thinks we're in an earlier part of the cycle, then maybe a recession is not likely in the next 12 months. I tend to think that we're in the later part of the cycle, and the signals, including yield curve inversions, are pretty clear to me that it's late cycle. Now, late cycle can last a very, very long time, right? Late cycle could last a year and a half, it could last 2 years. And in fact, there's no limit, right? That's the thing about the economic cycle, is that we have no idea how long each phase is going to last, including recession. But I do strongly believe that there has to be a reset. And that reset is something that uninverts the yield curve in multiple places. It takes care of inflation in the sense of brings supply and demand back into balance. Now, the Fed has done a lot of that work for us, but there needs to be a restart so that we get back to early cycle behavior. And generally, valuations would come down to a more palatable level before we embark on a new bull market. New bull markets don't typically start from elevated levels, so that's what makes me skeptical of this one.
Interesting. You're not the only person who says there needs to be a reset or is expecting some kind of reset, although, you know, we are seeing some differing perspective from Jan from Goldman today. All right, Liz Young stays with us. Retail sales in June came in cooler than expected, advancing by just 0.2% month over month. The expected increase was 0.5%. Now, this is the third consecutive month of positive retail sales, but the report shows decelerations in many discretionary categories like department stores, gas stations even, garden equipment, and hobby stores. Could this report throw a bucket of water on the soft landing crowd? We want to bring back in Liz Young, SoFi head of investment strategy. So we've talked obviously about the consumer and potential kind of cracks in the armor, if you will. So what does this do first with that question with regard to kind of the thesis for the soft landing crowd?
I'm still not clear on what soft landing means. I think it means different things to different people. I think to some of the crowd, it means no recession at all. I think to some of the crowd, it means a mild recession. So
well, what does a mild recession even mean, for example?
And then you have to get into the weeds of what does an average recession look like. So I'm going to say there's classic recession, which is, as we talked about, something that resets the cycle. You've got unemployment that rises, consumer spending comes down, you see a blowout in credit spreads, the market comes down, right? So classic recession. I think soft landing is probably something much more mild than a classic recession. In that scenario, I would actually envision that retail sales softens and that the consumer stops spending as frivolously, perhaps, as they were right out of the pandemic. Now, first of all, it's important to note that retail sales is much like consumer sentiment readings. They can be very fickle. They change very quickly. But here's the thing that's also important to remember about retail sales. If you start to see a trend of slowing and then contracting in retail sales, that usually indicates that the consumer has, at least in the medium term, pulled back, hit the brakes, hit the pause button, right? So what could happen is we had a bunch of revenge spending after the pandemic, and that revenge spending lasted a long time. And some people are still engaging.
I was going to say it's still happening for some.
It's probably not over.
Experiences, you know.
Exactly, right. So it started with stuff. We all bought a bunch of stuff, and then it went into experiences. And I think some of that is still going. I mean, ask Taylor Swift how it's going. I think it's going really, really well, right?
Yes.
So there's still a lot of that sort of revenge FOMO spending that's happening, and travel is still pretty hot. People are now traveling internationally, and that's a big thing. Over time, what you see, and what we've already heard some indications of, is when you watch things like retail sales, that's the smaller stuff, right? That's people going out and buying apparel and smaller spending. What you also want to watch in concert with it is durable goods. And durable goods spending has slowed down a bit. Durable goods, for anybody who's not aware, is things like big ticket items, right? Washing machines, right? Or things that you have to put into your house when you're remodeling it. And durable goods spending is usually one of the first things that people slow down on. Like, let's hold off on that washing machine purchase until we're sure that inflation is actually going to come down, right? In the last couple of months, I think consumers are feeling pretty great. I think market is up, inflation is down, they still have a job, and it's like, you know what? Let's do it again, right? So you might see a little resurgence in spending just because of how the sentiment surveys have come in. Sentiment surveys tend to be a little bit more real-time. Consumer spending and retail is a little bit more backward looking, so I wouldn't be surprised to see retail get a little bit of a bump the next reading that we get.
I mean, it's really interesting you say that, because two of the strongest areas, which really surprised me, furniture and home furnishings, and electronics and appliances. Which who would have thought that we would be talking about that at this point? When you're looking at the market, is consumer discretionary an area that's interesting to you, or not, given kind of what you're saying?
Right
and you have to be really careful about the consumer discretionary sector. There are certain companies that fall into that drive a lot of the behavior, and if you take those companies out, actually the sector looks very different. But consumer discretionary has gotten swept up into not necessarily the AI boom, but this growth rally that's happened in 2023, I think it looks extended from a valuation perspective. Generally speaking, so you can look at a couple different things. You can look at the ratio of consumer discretionary to consumer staples, and that would tell you whether or not the market was feeling comfortable cyclically. Does the market expect a cyclical expansion? So if discretionary is outperforming staples, then the market is feeling pretty good.
Right.
And right now, that's what's happening, right? At some point, those big gaps, again, they do tend to narrow. And I think in the case of consumer discretionary, just because of how high valuations are, the more likely scenario is that discretionary lets a little bit of air out of the balloon and staples maybe middles along. If we get a spike in volatility, you'll see staples come back into the forefront. And that's something, too, that I think as you watch the market and think about sectors, the VIX is incredibly subdued. I'm looking at a chart of it right now. The VIX is incredibly asleep, perhaps. We could even say. The VIX is like, I'm done. I'm going to go chill out for summer. Yeah, I'm not paying attention. And this is a time when, although it feels counterintuitive, this is a time when you actually want to have some defensives in the portfolio because it's probably not going to stay subdued forever. Now, spikes also don't last very long. So it's not as if I'm saying, oh, it's going to go up to 25 and stay there for 2 months. No, so if there's a spike, that's the definition of a spike, right? It spikes
Right.
and then and then it just sort of dies off. But you do want to have some exposure there. So not getting overly exposed to things like consumer discretionary and expecting that the recent past is going to extrapolate out into the future forever. Stocks don't only go up, right? And volatility will probably go up at some point in the next 6 months, and you want to be prepared for that.
Okay, I like
Good to
it.
keep in mind. And on the consumer discretionary front, they are later in the earnings season. At least the retailers
Correct.
are more towards
That's
the end of
correct.
August. So that's something
Yeah.
to keep an eye out for.
Yep.
Liz, thank you so
Thank
much for
you,
coming in
Liz.
and spending some time
Thank you
with
for
us.
having
Good
me.
to see you. Liz Young is SoFi Head of Investment Strategy. We got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. What sector is going to perform the best during earnings?
I think this market is ready to rotate, so I would look at things like financials, energy, perhaps industrials, and I think consumer is always one to watch. I think tech is going to do well, but I think this market is ready for something else to do well also.
we are listening to the opening bell on Wall Street as we kick off trading this Tuesday. Let's do a quick check of the markets, sponsored by Tasty Trade. We'll take a look at where things are opening. We've got the Dow down a little bit, off by just 30 points, less than around the 0.1%. The S&P's down by 5, also off 0.1%. Nasdaq, though, not showing yet where the opening is. Looked like it's gonna.
There we go.
See. There we go. Also off, but just by 0.25%. So this will be one to watch as investors digest the latest earnings out this morning. Let's get over to Julie at the Wi-Fi Interactive.
Here's a fun fact for you. Do you know why it takes the Nasdaq longer to open up?
I have been wondering that. What is the deal with that?
It's a lot bigger than the others. That's all it is, right? You got the Dow 30, you got the
Yes.
S&P 500, you got the Nasdaq Composite, which has like a couple thousand stocks in it. So it just takes longer to figure out what all the opening prices is, and then for it to calculate the whole overall index
movement. I was like, that number looks like yesterday. What's up with that?
Yes, it always takes a little bit of time for that Nasdaq to open up. So that's what's going on there. But let's take a look at what's happening here in the markets as we open up here this morning. And we're not seeing a refresh here on our Wi-Fi Interactive. That takes a minute too for our numbers to come through. So indeed, we are seeing this little bit of a downdraft today. What seems to be going on potentially is people sifting through these latest financial results that are not sort of no-brainer strong as the earlier results that we got at the end of last week. So let's take a look at the sector action, shall we, to see how that bears out as we get underway this morning. The XLF is actually doing the best today. I stand corrected. It's up, but it's only up about 0.1%. We've got consumer discretionary down. We had that disappointing retail sales report coming in with a gain of 0.2%, both on the headline. And then if you strip away the energy, gasoline price spending, it still came in disappointing. So that perhaps being shown here. We've got tech that's down. We've got energy that is down as well, even as we see a little bit of strength in the financials. Let's take a look at the Nasdaq, shall we? Because there, too, we're seeing some red on the screen. Not huge movement, but a little bit of declines here. Tesla, remember, is going to be reporting those shares are down about 0.75%. And let's take a look at the banks, shall we? Because we've been talking about the earnings from these companies this morning. Bank of America had been sort of bouncing around a little bit. Right now it's in the green, up better than 2.5%. So that's the open there for this one. And then I'm looking here for Morgan Stanley. It is up by 1.3%. But of course, Diane, those are not the only financials to report.
They're not. We're going to get to the regionals. We're watching shares of PNC. Now, the regional bank's revenue falling short of expectations in its second quarter. Stock getting dinged right now, down about 1.5%. The firm also cut its forecast for full year net interest income, despite seeing a 15% jump this quarter. Joining us for our chat today, a deep dive on this, Yahoo finance reporter Alexandra Canal. Ali, let's get into these PNC results. I mean, it's been something that we've been watching and, sharp focus on PNC because of it and the issues in the regional banking sector, right?
Yeah, PNC kicking us off here. Clearly, we're seeing some of that fallout from the SVB collapse in the spring. We see there a beat on earnings, although it was flat year over year, a miss on revenue, a decline in deposits. But what really seems to be driving the declines in the stock today is that forecast cut. Net interest income is a key metric for profit for these banks, but that wasn't the only guidance slash that we got. We also saw forecasts slashed for non-interest income along with revenue and period end and average loans. And it was interesting that we saw average deposits decrease by 20.8 billion year over year. PNC blamed those declines on quantitative tightening from the Fed, along with increased customer spending and consumer tax payments. So consumers still spending, deposits impacted by that.
The banks have been telling us our expenses are going to be going higher, right? And so this appears to be one of the things that's happening at PNC. In addition to deposits going lower, they are one of the reasons they cited for the cut to the forecast was higher deposit costs, also modestly lower loan growth, which is being echoed by a survey from the New York Fed that you flagged for us this morning, and softer capital markets. So all of that, not providing a great setup.
You're seeing a lot of things decrease in terms of their balance sheet. Net interest income decreasing from the previous quarter as well. So falling, it was net interest income 3.5 billion, down by 75 million from the first quarter. So, I mean, we knew PNC was going to be under some pressure, and they're certainly in the hot seat in terms of their position as a regional bank and the continued cracks that we can see there. I want to get to one other financial that we're watching. Charles Schwab, on the other hand, seeing a boost, jumping 13% after its second quarter results. Now, the firm saw bank deposits, revenue, and net income fall, but its earnings beat analyst expectations on it beat on both the top and bottom line. Now, we know Schwab has had a tough year so far, but investors certainly hoping for optimism on the horizon. Are certainly buying into optimism right now. I am a little surprised about that jump in his share price, right?
So I'm just trying to look for updates here, maybe something from the conference call, because deposits here fell 31% from a year earlier, but that wasn't as bad as estimated. Apparently, executives are saying they think things are going to be growing again by year end. So it seems like the market is seizing on that. And look at that dramatic boost in the stock.
Yeah, and I think the conversation when we talk about these financials, the banks, it's better than feared, right? Given what we saw in the spring. So if you beat earnings, even though year over year we saw declines across the board, Wall Street is still going to reward you. Now, in that earnings release, Schwab said consumers have been realigning their cash, and that, coupled with net equity buying during June, limited those cash levels, which pressured revenue in the quarter as Schwab had to rely on supplemental funding to compensate for that realignment. But Schwab did say they are seeing a deceleration of cash outflows as we head into the back half of this year and into 2024, and that should unlock growth in client cash in the back half, but that's a TBD factor.
Yeah, I'm not seeing the kind of the rationale for this jump in share price.
Again, I think that people are seizing on that commentary around deposits. The other thing that you have to consider is expectations when you go into this, right? This is a stock that is down 32% year to date, ex today's gain. And really, amidst all of the chatter about the fallout from the banking crisis in the spring, Schwab was one of the companies that investors really zeroed in on as being troubled, as potentially seeing a hit to its deposits.
And they said they weren't. So
they tried to come out and reassure investors, and we saw a bounce off the bottom, but the stock's still down by a third year to date. So I think coming into this, there is that low bar that
that we talk about with the financials.
Perhaps,
indeed,
exactly. Let's turn outside of the financials, shall we? Lockheed Martin shares, they are up by 1.7%. They reported better than expected second quarter results, and the company also raised its guidance on strong demand. Sales for full year 2023 now expected to come in at about $66.5 billion. Prior guidance was about $1 billion below that. Earnings per share forecast at $27.10. The prior forecast there at $26.75. So it looks like there we are seeing military spending still help things. There were some supplier disruptions that hurt matters at Lockheed Martin, but seems to have recovered.
But certainly the war in Ukraine continues to be accretive to Lockheed Martin. So the fact that that is ongoing, extensive, conflict that's happening, that's going to continue to help the company. I mean, it is the world's biggest defense company.
Yeah, it's like a tale of two sectors, right? You have the banks slashing guidance across the board. You have Lockheed Martin saying, oh, there's more geopolitical tension. Let's raise that guidance up there. But yeah, I think the war in Ukraine, also the ongoing tensions between the U.S. and China, I think that's only going to escalate considering the Biden administration's plans to restrict investments in China. We had Janet Yellen over there recently to try and ease that, but the general consensus across the board is China's not going to be too happy about that. So clearly a lot going on geopolitically that can be a boost for Lockheed.
And of course the defense budget as well here. I mean, we always, add to that. So
yes, it's true. The company has had some delays for its F-35, so that's something that's been an overhang. So this forecast that we're talking about represents a return to sales growth for the company. And all of this geopolitical stuff notwithstanding, I mean, we're not scrambling jets over China right now, so let's not get ahead of ourselves. But there, obviously there is this underlying demand here. We're going to talk more with Chris Versace in just a moment about this, because Lockheed is a stock that he likes. And we're going to talk about the defense bill, which has seen some roadblocks.
Yeah, jets versus balloons. Remember the spy balloon?
Yes.
Okay. All right, we'll put a pin in Lockheed Martin and come back to that. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Will the S&P 500 be higher or lower at the end of earnings season?
The end of earnings season, potentially higher. I think it's a tough call, but potentially higher.
Why?
Because I think there's been a lot of doom and gloom coming into this reporting season, and while I don't feel, super enthusiastic, I think the doom's been overstated.
I always tell people that they should be maxing out their 401ks. And if you can't max it out, start somewhere. It doesn't matter if you start small and then you up it every single year, even 1%.
There's no question that the current economic environment we're in, with inflation running as hot as it's been for the last 2 years, has caused people to be in more of a pinch than maybe they were before.
There's two ways to really build significant wealth. One is through real estate, great investment, you get some tax advantages. Stocks are the other way. For most people, that's going to be the most viable way.
First, you've got to have savings. Second thing you want to do is really maximize your employer plan. You want to make sure you're getting the full match before you do anything else.
All right, well, the Dow has notched a new high for 2023. An old Wall Street forecasting tool making a comeback with that in mind. Joining us now is Jared Blickrier, who I like to call Professor Jared, especially in this instance. So what is Dow Theory? Take us back to school.
Well, Charles Dow, back in the day, and you might know him from the Dow, he posited that if the two stock market averages, and it could be the transports and the industrials, we'll get to those in a second, if they reach notable new highs within the same short period, then the broader market is likely headed higher. Now, the broader market back in the day was probably the Dow Industrials itself, and today we would consider that the S&P 500. But what we're really talking about here is just confirmation between multiple markets, among multiple markets, that we're in an uptrend. So here are the Dow Jones transports, and this is an average calculated year to date. You can see today is up over 2%. That's a pretty big move considering the rest of the market is a bit ho-hum. And you can see here, this is actually at a 52-week high on this 2-year chart. And I just want to point out something else. We have a series of lower highs here that has transformed into higher highs. So we had a downtrend coming into the end of last year, and now we have an uptrend. And this is being echoed, at least it's been confirmed a bit, by the Dow. Now, the Dow is also just barely at a 52-week high, although it probably want to see technicians want to see it break out and hold these levels a little bit more. But for the most part, the two Dow indices are confirming each other. Now, I want to point out to you what else is happening. Here's the tech sector. Here's XLK over the last 2 years. It has now come up. It is at a record high by a small amount. You take a look at home construction, a very diverse field, quite separate from what you might think is being done in the tech sector. Guess what? That broke out weeks ago. That is already at new highs. Then we can look at semiconductors. We can look at industrials. Industrials looks a little bit different here, but nevertheless, XLI at a record high. And finally, value. We talk about growth versus value. Value is at a high too. And given that SOX, that's the chip index, and also several other tech indices are at record highs, I think it's safe to say that we're seeing a broad participation in this rally finally.
Yeah, for now. We'll see if
There's
it
no
lasts.
guarantees.
No, there are no guarantees. It's true. Thanks so much, Jared. Appreciate it. Let's get someone else's take on this, whether this rally has broadened, what that implies for whether it can continue. Chris Versace is with us now, Tematica Research Chief Investment Officer. We're going to talk about chips with you, but I had to get you to react to what Jared was just talking about here.
I always like going to school. I thought he did a great job.
Right? He always does.
He does.
But, it is interesting because, some of the markets, like the housing market and stuff, I think it's, based on the charts, it's performed a lot stronger than I think a lot of people were expecting. Just given the some concern over the consumer, where mortgage rates are. So, to me, a lot of that really popped after the May housing starts data. So I really want to understand what we get later this week in the June housing starts data, see if it continues. Because you made a comment earlier about appliances, furniture, it all ties together. So I think the key here for folks is, take a look across the landscape, get those confirming data points as you start to think about the next move in the market.
So as we know, and we'll dive deeper into semis as we talk with you, tech has been the leader. In general, what needs to happen for this to broaden out?
Well, I think if you step back and think about the market in general, right? The S&P 500, the multiple on 2023 earnings is around 20 times, something like that. So if you look at the, 20-year high in the terms of the PE, forward PE, you're kind of bumping up against that. So I think for the market in general to move higher, you've got to see stronger than expected earnings growth, both for the second half of the year and then possibly for 2024. And make no mistake, it's a high hurdle, right? Second half of the year compared to the first half of the year, the expectation is that basket of 500 stocks grows its earnings collectively just over 7%.
Right.
Now, is the economy doing better than people expected? 100%. Is the dollar moving in the right direction for multinational companies? Yes. Are we starting to see signs of real wage growth? But all good things. But we also have concern about what student debt payments are going to do when they finally come back in vogue. And last estimate I saw, it said on average it's about $400 a month. So that could be a turbo hit to the consumer as we move into the year end. So there's a lot of questions I think we need to get answers to over the next couple of weeks.
And there is also that backdrop of high expectation. So let's zero in on the chip makers as promised. TSMC and ASML are both set to report this week. Shares of both companies have soared more than 30% year to date. As investors look for AI hype to materialize, what should we expect from these companies? Chris Versace, I know that you are focusing on this area. Most of the attention is focused on NVIDIA. But of course, there are other chip makers out there. How are these guys going to do?
So I think you really have to differentiate the two because they are very different types of companies, right? So TSM is the biggest foundry. They make chips for other people, including NVIDIA. They'll be a bellwether for not only Apple, just given their strong relationship, but a lot of the different end markets, right? So high performance computing or data center, right? We've heard comments from Micron that, cloud has been good. AI has been driving their business as well. We should look for some follow through on that. But we also want to understand some of the other end markets that TSM serves. Second biggest one is smartphones, right? We know that there is some excess inventory in the channel, particularly in China, for Android phones. Is that clearing out ahead of the second half, which tends to be a seasonal ramp? So that's going to be key to know for companies like a Qualcomm, a Skyworks, a Qorvo. What are they seeing in automotive? It's another end market that we want to pay attention to, especially given recent price cuts that we've seen from Tesla, Ford as well. what does that mean for demand in the back half of the year?
What kind of risks?
I'm sorry. So it sounds like you're watching TSMC not as necessarily as an investor that you want to buy it yourself, but more as an indicator.
That's correct.
For what we're going to hear elsewhere.
100%. I mean, so the great thing about earnings season is you can get a lot of data that you can use both for your existing positions as well, their particular earnings reports, but you also want to be paying attention to what their competitors, their customers, their suppliers are saying leading up to what the companies you own or want to buy have to say. And I think TSM is a great example of that. But again, tech has been such a demonstrative force in the market year to date that TSM is going to be one of those first companies that give us a broad look at so many different end markets that we have to pay attention to it.
With ASML, what are you looking for there? Is it the CapEx or what are we looking for in terms of demand from ASML?
Two parts. One, we have seen such a pronounced move in these names. It's ASML, it's Lam Research, or even Applied Materials, which we own in the AAP portfolio. The expectation is that we're going to see a ramp in spending tied to reshoring, not only here in the U.S., but also outside the U.S., both in the Eurozone and Japan. So, these stocks have kind of moved a little bit ahead of that. The funds haven't started to flow, so there's some expectation there. We want confirmation that that flow is starting to happen, that there's a lift in expectations second half of the year and then into 2024. I think the last time I was on with you, Julie, we talked a lot about infrastructure spending. Those stocks have performed extremely well, and this is something in another vein, right? One of the big themes that I've had for this year is really leaning into stimulus spending. So that's everything from the Biden Infrastructure Act, the CHIPS Act, which is obviously referring to the Inflation Reduction Act, and there's a couple others as well.
A different type of government spending that is not stimulus spending, at least not coming from the IRA or some of the other recent legislation. Defense spending. Lockheed Martin reported this morning it raised its outlook, is looking for a return to sales growth. There is, however, the matter of the big military spending bill that is in Congress right now. The House passed it. The Senate's going to debate it, but it's been held up by some political issues. Is this, we know that the government's going to spend on the military, but how is this going to be specifically for Lockheed?
Well, I think it's going to come down to seeing the final line items on what the programs are, what gets funded. And make no mistake, this is always something that we focus in on. But I think the other part of the story here is non-U.S. spending on defense equipment. And obviously it's made a lot of headlines over the last few quarters, Russia, Ukraine. But there's some things that are happening outside of that, like the potential expansion of NATO. Right? If Sweden comes in, they'll have to spend 2% of their GDP on defense equipment. So as that happens and as others in that theater continue to spend, what kind of equipment are they spending on? Well, a lot of it is what Lockheed has. So I just think that they're naturally well positioned. You talked about their performance, their backlog hit a new record high, $158 billion. Talk about some great visibility over the next several, not just quarters, the next few years. So the key to me for that story is, can they get some margin improvement now and recognize the leverage that they're going to see as these volumes increase?
With Lockheed, one of their challenges has been the F-35, and the Pentagon has frozen new deliveries for the F-35 because they've had issues kind of meeting the deliveries that are already expected. Is that any cause for concern for you?
It sounds more like a timing issue than anything else, candidly. We'll see what they say on today's earnings call, if there's been any dramatic change. I don't think there will be. It's just a question of delivery times.
All right. Thank you.
Thank you, guys.
Good to see you.
Good to see you.
Chris Verzati, Tematica Research Chief Investment Officer. Appreciate it. We got all your markets action coming straight ahead. Stay tuned. You're watching Yahoo Finance. Is there a magic word like AI was last quarter, this earnings season, or is it just going to be AI again?
I don't think it's going to be AI. I think we're going to hear a lot of that, but maybe not quite as much because there's some pushback about it being overhyped. I think it's going to be some economic word, something to do with consumers, something to do with demand, the state of the economy. I don't quite know what that word is going to be, but I think it may be something like stability or resilience.
We've got much more on tap all day here on Yahoo Finance. Stay tuned for our 3 to 5 show today. That's where executive editor Brian Sozzi will be speaking with Bank of America CEO Brian Moynihan on the back of that big bank's earnings release this morning. You don't want to miss that.
All your markets action is straight ahead. Stay tuned. You're watching Yahoo Finance.
Have you tried out Threads? Do you believe that Threads is going to be the Twitter killer?
You know, I'm not sure if it's going to be the Twitter killer, but will definitely be some competition. I have an account on Instagram. I use Instagram. So yes, I did the Threads app, but in all honesty, I haven't gone through and looked at anything on there yet. Maybe it's a weekend activity. We'll see. But right now, I don't think it's stiff competition for Twitter.
All right, drop the @ for the team here, and we'll hit you with a few fresh follows on IG.
Perfect.
It is just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Diane King Hall alongside Julie Hyman. We're about 30 minutes into the trading day, so let's take a look at how stocks are moving. The S&P 500, a little change this morning. The market's digesting softer than expected retail sales results, and investors have a lot ahead with a busy day of earnings underway.
We are also watching shares of Bank of America this morning. The firm delivered sales and profits that beat expectations. The shares are up almost 4%. They were boosted by higher interest rates, the earnings that is. CEO Brian Moynihan calling it one of the strongest quarters in the company's history. Another mega bank, Morgan Stanley, also reporting earnings this morning, though profits there declined 13% from the year prior. Dragged down from lower trading results and severance costs from layoffs, the firms did see record wealth management results thanks to higher interest income.
Shares of Chipotle in the green after the restaurant chain announced new locations will open in the Middle East next year after signing with its first ever franchise partner there. Now, Chipotle is expected to open 2 locations each in Dubai and Kuwait. Franchise partner Kuwait-based Al Shaya Group has previously partnered with brands like Starbucks and Shake Shack. Shares of Chipotle up over 50% year to date, making it one of the best performers in the restaurant sector.
And we're also watching shares of Pinterest up this morning on an upgrade from Evercore ISI. The analysts there say more digital advertising spending could boost the social media company, noting the distinct probability of material revenue growth in the months to come. Evercore is also praising evidence of improvements under new CEO Bill Reddy, who's been at the helm for just over a year. Well, U.S. regulators are set to release a new framework for the banking industry next week. The sweeping overhaul is expected to lower the threshold for capital requirements to include banks with at least $100 billion in assets. That's a bar far lower than the existing $250 billion cutoff. Dozens of regional banks could find themselves suddenly beholden to new rules with stricter requirements. What does the landscape look like now for regional lenders? And I should mention, Bloomberg reporting this morning that in particular, regulators are going to be focusing on mortgage requirements as well. Kevin Wack is joining us now with more. He is the national editor at American Banker. Kevin, thanks for being here. So what is sort of the big takeaway here about these changes? How fundamental are they going to be to how the banks do business?
Well, I do think that they underpin the bank's business, the capital requirements, and they should have a significant impact on the regional banks, as you mentioned, the ones between 100 and 250 billion of assets in particular. The mortgage requirements that you talked about that Bloomberg was reporting on last night, I think those are expected to mostly hit the larger banks, but the impact overall of these capital rules on those mid-sized regional banks will be substantial.
So, Kevin, the regional banks have pushed back on this prospect of new additional scrutiny, citing that it would be more costly for them. Is the pushback warranted?
It will have costs for the banks. I think there's no question about that. Now, whether that outweighs all the other kind of benefits that come from higher capital requirements in terms of sort of the stability of the overall financial system, that's a different question. There's also been a lot of discussion about, whether and to what degree higher capital requirements will lead to less lending or a decrease in lending. And there's just a lot of debate about that. I don't think the research is super clear, but there is no question that there will be real costs to the banks.
And from what we're hearing, this is already a time when the banks have higher costs from other stuff, right, Kevin? In other words, at a time when many of their deposit growth trajectories are challenged, they have to pay more for the deposits they're getting. So that presumably is going to continue to put some pressure on them.
Yeah, definitely. And as the regional banks start to report their earnings this week, I think we expect to see that story continue to play out. The big banks, which have largely reported now, a little bit more shielded from the cost pressure on the deposit side. But PNC reported its earnings this morning, maybe the first at the regional banks. They showed some of that cost pressure on the deposit side this morning in their earnings report, and I think we'll continue to see that at the other regional banks.
And Kevin, I want to ask you, so one of the concerns for the regional banks is with this increased pressure and more regulation, more cost, the concern is that could then trigger more regionals failing. Is that a problem when you think about the kind of the overall banking landscape from your analysis? I mean, of course, it wouldn't leave us with just the big banks. You may still have the super regionals, as you call it, but it certainly decreases the options.
Yeah, I mean, what you had happen in the spring was three, not that they were regional banks, but they were not all that huge that failed. And, you saw really significant impacts throughout the banking sector from the failure of those banks, and just a lot of fear and anxiety that kind of roiled the markets. So if that were to happen again with more regional banks, I would, expect those domino effects to play out again. Now, I don't know that we're necessarily seeing signs that, we're on the verge of, more regional bank failures at the moment, notwithstanding some of the costs that you talked about. But, I do think that there are reasons that the market remains concerned, about some of these issues. The issue of unrealized losses on securities portfolios was a key reason that Silicon Valley Bank and First Republic Bank failed. And, there are a number of banks, many of them smaller, that have similar sort of unrealized losses as a result of rising interest rates. And so that's definitely something to keep watching.
All right. We will continue to watch the banking sector. I mean, we continue to get results today. We'll get more. Thank you so much to Kevin Wack, national editor at American Banker. Meantime, we are watching shares of PNC this morning. That stock up a little over 1%. We have more on what PNC's performance means for its small and mid-sized peers. For analysis on that, we're joined by Alexander Yoakum, senior equity research analyst at CFRA Research. Thanks so much for joining us this morning. Let's get into PNC's results. How does it look to you, especially when you compare it to the broader regional banking sector?
Yeah, thank you. Thank you for having me on. I think initially there was a little bit concern with revenue coming in a little bit light. But once you look past that, I think the results were actually quite strong. One of the bigger talks recently has been credit quality. And PNC's credit quality actually improved this quarter. So it's actually been 2 straight quarters of improving credit quality, which I thought was a really good sign, considering, they're trading at a pretty depressed multiple right now. So if the credit quality can stay strong, there definitely could be some outperformance there. There was also a little bit of deposit runoff, which has been, sort of a trend for regional banks in general, obviously following the collapse of Silicon Valley Bank. But it wasn't that significant, and PNC has excess deposits. And by allowing some of those deposits to run off, they actually kept their margins pretty strong. So their net interest margin only fell 5 basis points quarter over quarter. And we think that bodes well for profitability going forward. Maybe that won't be so strong at other regional banks that have a little bit less pricing power. But for PNC, we thought the results were actually pretty good.
I'm curious, Alex, it's Julie here. How flexible, how mobile, how mutable are deposits? Because we talked to an investor earlier who said, people right now are going into things like money markets, other short-term instruments where they're getting a higher rate coming out of their bank accounts. Once that starts to change, though, do you expect those flows to come back?
So, yeah, I guess the flows could come back if interest rates fall. But I think it's worth pointing out that, the 3 banks that really struggled, if you think about First Republic, Signature Bank, and Silicon Valley Bank, they all had very high levels of uninsured deposits. And that basically translates to large account sizes, right? And if you have a large account size, higher interest rates, you're more likely to want to search for yield. But PNC, their average consumer account size is about $11,000. Right. So a 1% change in interest rates is not that significant in terms of the income you're earning. It's much more important about services. Right. So we think banks that have high levels of insured deposits, right, so smaller account sizes, face less of these pressures.
So who are you concerned about in light of that, Alexander?
Yeah. So, definitely the 3 banks that struggled. But, 2 banks that potentially have issues just because they also have high levels of non-interest bearing deposits, which have been shown to see higher outflows. Zion and Comerica have a little bit of potential pressures. But it is worth noting that they're generally they have sold off pretty significantly. So if they had any deposit surprises on the upside, they could potentially see really strong results.
Yeah, I was going to ask sort of the flip side of that, and who you think is going to weather all of this the best.
Yeah, so from the large regional banks, we actually do like PNC as our top pick, just because we really like them on the deposit side. And then there have been a lot of talks about increasing capital requirements. So the three super regionals, PNC, US Bank, and Truist, we think PNC is best positioned because Truist and US Bank have some larger unrealized losses in their securities portfolio, which could potentially dent their capital ratios if there's reforms there. PNC on the large banks, like I said, very well diversified. Their CEO has a very strong track record of success, has outperformed over the last 10 years the peer group pretty significantly, and we think they're well positioned going forward given that well diversified banking model. And like I said, on a deposit perspective, we think they're well positioned to not necessarily face as much pressure than the rest of regional banks.
Well, that makes sense. I know, in terms of their credit quality performance, as you mentioned, they did better. Their net loan charge-offs were stable, as they noted in their earnings report. Are there any risks on the horizon that would concern you when it comes to PNC?
So the credit quality was better. I guess the risk there is office, right? So they do have some office exposure. We did see charge-offs increase pretty significantly this quarter. They almost tripled, which sounds bad, but it's coming off a low base, and it's a small percentage of their portfolio. In terms of that, there's some concern just because office. It's tough to see that getting significantly better going forward. But since it's a small percentage of the portfolio, we think it's they're well positioned. I mean, I think funding costs, like we said, we think PNC is better positioned than other regional banks, but the entire industry could underperform if these funding costs continue, if interest rates stay high, and if consumers continue to move their money. Because right now, if you're trying to gain deposits, it's very expensive, right? So if you let some deposits run off, that's okay to keep costs low, but trying to actually add deposits is very expensive in this environment. So if this continues and you're trying to add loan growth, that could become very costly going forward if this environment continues.
Yeah, and it's certainly not out of the question that it will continue, at least for a little while here. You mentioned commercial real estate, and so how should we be thinking about that exposure right now amongst the regional banks, especially since that issue has been so talked about?
Yes, yeah, there was definitely, I think, a negative reaction last week to Wells Fargo. They were pretty conservative on their commercial real estate, increased their allowances. So we think, because regional banks have larger exposure to commercial real estate, there's definitely concern there. But I think the positive is most of commercial real estate is actually okay right now. It really is office. And that is a small percentage of these banks' portfolio, typically 2%, 3%, 4%. Relatively well positioned. We also like that they've had a long time to prepare for this. One reason why, the collapses in the spring were so sudden was because it was a factor that people weren't necessarily as concentrated on. Being unrealized securities losses. That wasn't necessarily, something people were talking about. And then like uninsured deposits, those were arguably considered positive because, wealthy clients tend to be more profitable. That was a quick flip. Whereas, commercial real estate, office, it's been known for a while now. So we actually think, generally speaking, these executive teams have done a pretty good job building up reserves and preparing for a potential downturn.
Well, we're just at the beginning when it comes to the regional, so it should be interesting. Alexander Yoakum, thank you so much for giving us your perspective. Senior Equity Research Analyst at CFRA Research. Appreciate it.
Thank you.
We got much more markets action coming up. You're watching Yahoo Finance. When does the upcoming presidential election start to affect stocks?
I think it's already starting. I think that coming out of the debt ceiling drama, I think Republicans had some momentum, and I think that actually ended up propping up the S&P a bit more than people realized. I'm already getting a lot of questions, especially from overseas investors, about the nomination process, when it's really, getting underway, if anyone's going to challenge Biden, what's going on with DeSantis. So I think international investors at least are already paying attention in a big way.
Let's do a quick check of the market sponsored by Tasty Trade. We've got a mixed picture now for the major averages, with the Dow leading gains here, up by 0.6%. The banks probably not hurting matters there. The S&P up about 0.2, and the Nasdaq down by about the same amount. Remember, we are waiting for the big tech earnings to begin as the big bank earnings wind down. Retail sales rose at a muted 0.2% pace in the month of June, coming up short of Wall Street estimates and showing slowing growth from last month. So what does this show about the state of the consumer? Matthew Luzetti joins us now, Deutsche Bank Securities Senior Chief U.S. Economist. Good to see you, Matt. Thanks for being here. So retail sales, I got to tell you, Matt, it is a confusing time, right? You have consumer confidence that's doing pretty well. Retail sales kind of meh. How do we synthesize all of this?
Yeah, so certainly from a consumer confidence perspective, we've seen a rebound in the past 2 months.
Right.
But from a level perspective, it remains well below where we were from 2019. So there's not necessarily this big disconnect there. Actually, within the data this morning, I would have taken an optimistic or more positive tone. If you look at retail control, which is the underlying details of the report, strips out some of the volatile items like gasoline, it was actually stronger than expected with some upward revisions. So all told, I would take away from the consumer, it still remains resilient at this point.
Do you like what you saw in terms of some of the categories? We saw growth in, as you teased this out earlier, furniture, home furnishings. So there was a decline in department store sales. What do you make of the categories?
Yeah, I think we've all, over the past year, been anticipating that you're going to see good spending, particularly in those household furnishing items, coming back down to the pre-COVID trend. The idea was, as you've gotten beyond kind of that big pent-up demand that we had, that you would see a reversion to norm. You really haven't seen it in a lot of those categories so far, and you're seeing some consistent strength there. Previously that was a source of upside surprises for inflation. As Fed officials were surprised by upside inflation, they're talking more about the goods items. It does appear like that inflation impulse is probably behind us, which is an important development from the Fed.
So how long does the consumer remain strong?
Key question. We have a key input into that has been thinking about excess savings that households have. We still think they have above $500 billion in the aggregate, but that becomes increasingly skewed towards the upper end of the income distribution. I don't take it as being a key input, perhaps, into the spending that we're seeing at the moment. As we look ahead, we expect that the labor market's going to be decelerating, that you're going to see jobs gains decelerating. As that excess savings is drawn down on top of that, you've seen rising delinquency rates. So I think there's early signs of some slowing in consumer spending. But no doubt, many people have been looking for it over the past several quarters, and it really hasn't come through as much as anticipated.
Let's talk about student debt for a moment as well, and how it's going to feed into consumer spending, and not just consumer spending, but the big picture, the bigger picture. I was talking to a friend recently who has kids who are recently out of college, who has their friends have a lot of student debt, and he pointed out that not only if you have to now make these debt payments that you didn't before, that means you're not going to be buying whatever or going on whatever trip. Yeah. But maybe also that money might have gone into the market, and now it's not going to be going into the market. So what's your big picture view on how big that impact's going to be? Yeah, so if you quantify it, we think it's about $60 to $70 billion annualized from household income, which is not trivial. It's certainly a big amount. If you put it as a share of total consumer spending, it's probably 0.3 to 0.4%. So it's meaningful. It's particularly impactful, obviously, for those households that have student debt, and we've seen some stresses for them. So if you look at auto delinquencies for younger households, they're actually well above where they were from a pre-COVID perspective. And so I do think that's an important potential headwind for consumer spending. At the same time, we see the Biden administration trying to take other actions in order to dent or kind of mute the impact, have it come in more gradually. And so it does not appear to me like that's going to be a key source of downside at the moment, probably in Q4. It may take a little bit more time for that to be impactful.
Can I ask you about what your perspective is on where we stand with regard to recession risk? And the backdrop being that we got a note out today from Jan Hatzius over at Goldman Sachs. So maybe your arch nemesis, I don't know. But they've reduced their probability that a recession will start down. They've reduced it from 25 to 20% prediction, so definitely lower. One, where do you stand on expectations for one? What's your probability first before we kind of dive a little deeper into this?
Yeah, so we've had, going back to last April, we've had a baseline call for recession at the end of this year. We've kind of termed it as a mild recession. We've kept that as our base case. I do think that you've seen developments recently that have been supportive for the soft landing camp, that give us maybe a wider avenue there. Number one has been inflation. Last week's inflation report was important not just because you saw a 16 basis point print for core CPI, but the underlying details were supportive. You saw that core services ex shelter component was softer. We had goods disinflation coming back. As we look over the next several months, used car prices are going to be softening. As we just talked about, perhaps that impact from student loan debt coming back might not be as severe if it gets spread out over time. So there are a few items there that I think are certainly helpful from a soft landing camp perspective, and markets are definitely responding to that over the past several weeks.
One of the interesting things that Hatsias points out in his note is that the yield curve inversion is not necessarily the predictor it once was, and he lays out a number of different reasons, including raising the question of whether it's just wrong, investors are wrong. How do you think of that indicator versus other ones that you track?
Yeah, it's typically, historically, very reliable. Over time, there's a lot of shifts that take place that always cause us to question, I think, whether it's as reliable as it's been in the past. I think the key today is not necessarily if you look at the 2-10 slope or 3-month 10 slope, but if you look at what the market is pricing in terms of Fed rate cuts, what is that telling us? Is that telling us that the Fed is cutting because a recession is imminent or is happening over the next 6 months? Or is it happening because inflation is going to come down and the Fed is sitting at a 5.3% Fed funds rate and they think neutral is closer to 2.5%, and therefore they can glide path down? I think that's the key source of uncertainty about the yield curve at the moment. I would focus on the rate cuts part, and I think that there's equal, or at least both parts are being played in there, that there are heightened recession risks, but at the same time the Fed may be able to cut rates simply because inflation falls, and they don't want to become increasingly restrictive over time as inflation falls.
It's so funny when you talk about like soft landing, because we had a conversation earlier with Liz Young about how some people are defining soft landing, with some defining as a mild recession, some defining it as no recession. I want to ask you in terms of the Fed funds rate and what you're expecting from the Fed through not just next week, but through the balance of the year. Are you expecting 2 more hikes?
We're expecting 1. We're expecting that they hike rates next week. Certainly have a lot of conviction in that going into the blackout period. Every Fed official basically signaled that that's a most likely outcome. But we've expected that to be the last hike of the cycle, that they don't deliver on the 2 hikes that they saw in their June dot plot. Mm-hmm. And that was basically thinking that you're going to see inflation come down a bit faster over the next several months, but also that you're going to see some evidence in the growth and labor market data that things are softening. So our baseline right now is the Fed raises rates by 25 basis points in July. It's the last hike of the cycle, and they basically sit there until they can cut rates eventually, either because we see a recession build and the labor market weaken, or because inflation is coming off.
Just to get a little perspective here, we keep talking about recession. We've been talking about recession for a long time now. And we behave as though like there's going to be this blaring sign when it happens. It's the instant we enter, you're in a recession, and that's not really how it works. How are we going to know that we're in a recession, and when will we know, relative to when the recession begins, that we're in a recession?
I think it's all about the labor market. So I think the key for markets, for the Fed, is not whether we get negative GDP growth in a quarter or 2. We had that in the first half of last year, and the Fed did not blink at all. They continued with 500 basis points of rate hikes. So the only key, I think, is do we see the labor market weaken materially? We've done research in the past about what the best real-time indicator is for recession, and it tends to be continuing jobless claims. Okay. And we get that on a weekly basis. They're little revised, and so it tends to give you a very strong signal about what's happening with the labor market. Those were looking weaker several months ago. They've topped out over the past several months, have shown some moderation, and are certainly not obviously showing signs of recession at the moment.
Okay, is there a particular number that you're watching, a level?
So when we had done the analysis, it was always on a change basis. And I think that was important because there were structural changes over time. On a change basis, we have cut through all of those recession indicators. But that's because we were coming from historically low levels. I think I would want to index everything to where it was in 2019, because it's a question of,
that makes sense.
Are you seeing the labor market soften from historically and extraordinarily tight levels just to a level that looks more normal from a 2019 perspective, or is it outright weakening? Initial jobless claims look like an outright weakening. Continuing claims do not at the moment.
All right, we have to leave it there. Thank you so much, Matt Lazzetti, Deutsche Bank Securities Chief U.S. Economist. Stay with us. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
You have a demanding job. You also have little kids.
Yes.
Do you have a hobby or an extracurricular activity to blow off steam?
I wish that I did. Sleep, is that one maybe?
Yes, that totally counts.
Yeah, I mean, honestly, I'm trying to prioritize sleep and taking care of myself. And honestly, I just love playing with my kids.
The SEC is still processing the court ruling on Ripple Labs, with Chair Gary Gensler saying he's both pleased and disappointed with the decision. Yahoo Finance's Jennifer Schonberger sat down with Gensler for an exclusive interview yesterday, and she joins us now with more. Jen?
Good morning, Diane. In an exclusive interview Monday, I asked SEC Chair Gary Gensler whether a ruling on Ripple's XRP changes the SEC's approach to regulating crypto and specifically crypto exchanges. Take a listen.
In terms of the decision, we're still taking a look at it. We're pleased with how the court's addressed itself to that a token for institutional investors is a security, how they address themselves to fair notice, disappointed in other aspect about retail investors, but we're still taking a look at that and considering it.
A judge in the Southern District Court of New York ruled last week that XRP is not necessarily a security in and of itself, but it was a security when it came to institutional sales. The judge, however, punting on whether XRP would be considered a security when the tokens are sold on crypto exchanges. The crypto industry is interpreting the ruling as sales of XRP on a crypto exchange are not securities. I asked Gensler what he'd say to exchanges based on their interpretation of the ruling. He implied that crypto exchanges are still in violation of securities laws.
There's ongoing litigation with regard to a number of these crypto platforms. And these crypto platforms are commingling a number of services that you've seen on these crypto platforms where they could well be trading against their customers, bundling up a bunch of services that we would not allow in any other parts of our capital markets.
Gensler told me it's too early to determine whether the SEC should write customized rules for crypto in light of this ruling, though he said current securities laws still apply. Now, I also asked Gensler about the risks of artificial intelligence. He warned that a number of companies control much of the technology, giving an example of everyone relying on the same base model for their mortgage or stock information. Gensler said if one of those models were to run into trouble, that could threaten the stability of the financial system, telling me it's possible that could lead to a financial crisis. Now, Gensler called for a serious conversation amongst global regulators on AI and says the SEC will need to write more rules to safeguard against AI. Back to you.
Thanks, Jen. Appreciate it. West Virginia Senator Joe Manchin sparked more speculation that his name would be on the ticket for a third-party 2024 presidential run following his campaign-like event sponsored by centrist group No Labels yesterday. The Democratic senator seemed to leave the door open for a possible run at the event.
If we're showing you the common sense that most Americans want to be governed by, and neither is doing that, and we can't push them back to the middle, that'll be a time to make a decision, whether it's me or anybody else. We're not here. I'm not here running for president tonight. I'm not. I'm here trying to basically save the nation.
I'm not here running for president tonight. So what if he was running at some point? What would that mean for the landscape of the presidential election? Yahoo Finance's Rick Newman is with us now. So Rick, what would it mean?
It would mean bad news for President Biden, probably. The concern among Democrats is that somebody who's a centrist figure, such as Joe Manchin is, the senator from West Virginia, that if he were to run as a third-party candidate, which is what this No Labels group is all about, that would basically siphon votes away from Biden in a general election. So that would benefit Republicans and make it more likely that the Republican nominee, whether it's Donald Trump or somebody else, could actually win. I mean, just remember in 2020, Biden did win pretty decisively in terms of the electoral vote, but that electoral vote win came down to extremely narrow margins in about 4 or 5 states. And if you could get some of those swing voters not voting for Biden and voting for a third-party candidate, that could be decisive based on the margins we saw in 2020. So that's a concern for Democrats. Now, other people say Manchin is, he's got a hero complex. He says he's there to New Hampshire to save America, that he's an attention hog, and that he's just preening for the cameras and enjoying the attention, that he will not actually do this because he's a little more committed to the Democratic Party than that. But it creates a little bit more drama in an election that's already looking kind of interesting.
Yeah, indeed. Speaking of interesting with regard to the presidential campaign, you mentioned former President Donald Trump, who says he's been notified he's a target in the DOJ's probe into efforts to overturn the 2020 election. So, Rick, what does that all mean in terms of his candidacy?
So that probably means that Trump is going to be indicted again. So for everybody who's lost track, this would be the third criminal case of criminal prosecution against Trump launched this year. And there probably is a fourth one coming with regard to charges of election fraud in Georgia. That could be imminent as well. Trump is facing a gigantic legal mess. So this is going to make it very hard for him to campaign like a normal politician. But it has turned out to be good for him in one regard. Every time there are new charges against him, he sends out fundraising pitches, emails, and text messages, and people send him more money. So Trump may end up spending more time in court than on the campaign trail, assuming he goes forward with his 2024 campaign. But so far, he's got plenty of money because this has turned out to be a fundraising boon when Trump says, oh, the Democrats are prosecuting me and persecuting me. It works. People send him money.
Remind me, Rick, is he allowed to use that money for his legal defense?
He is not. That money goes into different types of political action committees, campaign committees, and there are rules about how he can spend that. He can do separate fundraising appeals for something like a legal defense fund. I don't know that he is doing that, but if you're donating for one of his campaigns, no, he cannot just use that money for private legal defense.
And Rick, one of our producers this morning thought it was April Fool's Day when he saw this story. BlackRock has named the CEO of Saudi Aramco to its board. Why did this seem like a joke? Well, BlackRock had been the poster child for ESG investing. And well, recently, as you and I discussed in a recent roundtable, BlackRock has really stepped away, and you've written about this, has stepped away from that ESG label. I mean, it's one thing to step away. It's another thing to appoint the head of the world's largest oil producer to your board.
Right. So with regard to BlackRock, I mean, BlackRock is so big. I believe it is the world's largest money manager. If not, it's in the top 5. They cannot just ignore or shun an entire sector of the investing world, such as energy or fossil fuel energy. It remains to be seen if they are just going to rebrand their, Larry Fink's ESG focus. I mean, he has said the term has been weaponized, but he also says he remains committed to focusing on transition investing, which means from the carbon economy into a renewable fuel economy. In a normal world, there's nothing at all strange about having the CEO of the largest energy firm in the world on your board. And just to remind people, we have not even reached peak oil in the world. I mean, we remain heavily dependent on carbon energy. We might hit peak oil by around 2030, but even then, it's not like oil's going away. I mean, the world is going to need these forms of energy for literally decades. So this is maybe a nod to reality. You just have to acknowledge this type of energy is crucially important still. We just cannot flip over to, solar energy and wind by moving a few dials. It's going to take a heck of a long time and tons of infrastructure build out.
Right. And that indeed, that acknowledgement does seem to be broadening. It's not just BlackRock, which is indeed the world's largest asset manager, but that realization seems to be more widespread as well. Right?
I mean, one last thing I'll toss in there. So BlackRock, like many other big firms, shunned Saudi Arabia after the murder of the journalist Adnan Khashoggi, which I think was in 2018, which is linked to the Saudi crown prince. Now they don't seem to have such a problem with that. So we are seeing, even though the evidence is clear that murder was linked to the crown prince of Saudi Arabia, the world is kind of saying, we don't care that much anymore. Let's just not forget that.
Yeah, that is a very, very good point, Rick. Thank you. Appreciate it. We got all your markets action coming up. You're watching Yahoo Finance. Barbie or Oppenheimer?
I don't know what Oppenheimer is, so I'll say Barbie.
I'm in the Barbie camp as well. Oppenheimer is a movie about the development of the nuclear bomb, yada, yada. And there are some people allegedly who are doing it as a double feature.
Okay.
Although that seems an awfully strange double feature to me.
I was aware that the Barbie movie was out. I've seen a lot about that on social media, but going back to the question on hobbies, I don't even watch TV or movies anymore. So
yeah, and neither of those movies is kid friendly for the age that your kids are.
Yes, we're watching things like Bluey and Mickey Mouse and Coco-Melon. I think I'm saying that right.
Coco-Melon, yes.
Hi, Barbie.
Hi, Ken.
I thought I might stay over tonight.
Why?
Because we're girlfriend, boyfriend.
To do what?
I'm actually not sure.
Mattel is betting big on the Barbie movie. The live-action film, starring Margot Robbie as Barbie and Ryan Gosling as Ken, reportedly has a $100 million budget. It's a toy maker's big chance to shake up its brand and prove that Barbie is still relevant. Barbie sales accounted for $1.5 billion of Mattel's $5 billion plus worldwide sales last year. It's a big number, but it's still down 11% from the prior year. Mattel unveiled the first Barbie dolls in 1959, and the company went public just a year later. The 1960s was transformative for Barbie. The Ken doll was introduced in 1961. The first Barbie dream house popped up a year later. The doll's popularity took off, with sales passing $1 billion in the early 90s. But within a decade, the doll began to fall out of favor amid criticism for lacking diversity and promoting an unrealistic body image. As Barbie sales struggled, so did its IP owner, Mattel. The company lost its spot as the world's largest toy company by market cap to Hasbro in 2015. Attempting to address some of the criticism, Mattel released a more body-inclusive doll line in 2016. 2 years later, Ynon Kreiz was named Mattel's chief executive, and he brought a new vision to the brand. Dig into Mattel's vast IP and pull out the toys that could translate into hit movies. In addition to Barbie, Mattel is planning 14 more films based on toys.
It will be a way for us to show what does it mean when we say that Mattel is an IP-driven, high-performing toy company, and an opportunity to extend our business outside of everything we do on the toy side of the company.
Between Mattel's business and the lackluster return to the movies, there's a lot riding on the film. So will people show up? We did a little research of our own.
Of course, I have plans to see the Barbie movie. I'm so excited. Yeah. Oh, yes. Yeah, absolutely. I want to see it. Yeah, unofficial plans. Yeah. I'm definitely going to see it. Yeah, definitely. Yeah, I would love to see it.
Yeah, I want to see it. I've been waiting for this for years.
We've had an astronaut Barbie, CEO Barbie, and presidential candidate Barbie. But will we get a blockbuster Barbie? We will see whether this hype translates into a Barbie boom.
The National Labor Relations Board reported that union representation petitions increased by 57% in the first half of 2022. The boom, sparked by Starbucks and Amazon workers across the country, had its moment but faded, with union membership ending the year at the lowest rate on record, with just 10.1% of all workers. Now, with over 170,000 Hollywood writers and actors striking in New York and Los Angeles, union organizing is once again at the forefront when it comes to the workplace debate. Joining us now, David Madlin, Center for American Progress Senior Fellow and Senior Advisor at the American Worker Project. Thank you so much for being here, David. And something that I have been so fascinated by really throughout the pandemic is this sort of shifting balance, if you will, in worker power versus the employer power. Where do we stand right now, and what does that strike in particular show us about where we stand?
Well, the strike's still ongoing, so I think we'll have to wait till the end. But what I think where we are with worker power versus employer power is, for decades, employers have had more power. Their profits have been increasing while wages have largely been stagnated. And workers have been increasingly frustrated by that. And so that's why you see this growing interest in joining a union or strikes and the like. And so this writers and actors strike, I think, is the latest test there. And the other parts about power that I think are important is sort of shifting technology has often given employers more power. So with the writers' strike, the streaming technology meant that they were losing some of the residuals that they were used to get, and whereas the profits for their employers were doing quite well. So, but it's also a full employment economy right now, which helps the workers. So I think we have this balance of technology pushing towards the employer side, but full employment pushing towards the worker side. And the strike is a good test of where we're going to end up.
Let's talk about the ripple effect, David, to the economy in general. We've done some reporting on the impact of the writers' strike to other jobs within that industry. The longer this goes on, the more difficult it becomes, in particular when you think about entertainment and whatnot. What is the line that gets drawn where it finally kind of come to some kind of resolution?
Well, that's the hope. No one in the short run, a strike is not good for anyone. The workers, the writers lose clearly for, a long period of time that they don't get an income, but also the studios are losing out. They're not producing. It's a test. No one can answer that in advance. It's a test of sort of your commitment as well as your kind of financial resources. Oftentimes, corporations have the larger financial resources and they can wait out the workers, but sometimes the workers' commitment is greater, that they really, really care. They feel that this is something personal at stake. And in this case with the writers, the use of artificial intelligence, I think, feels particularly personal, that writers feel like they are creating something new and different that can't be replaced, and they want some control over that. So I think that gives them a greater resolve than they might otherwise have.
David, over time, are unions effective at getting workers' wages and other benefits increased?
Of course, no doubt. Generally, unionized workers make about a little over 10% more than similar workers, similar education and the like. And it's also, as the graphic is highlighting, it's really important for closing the gender pay gap, that unions provide a particular boost for women workers. And they also, of course, increase benefits, more likely to have health benefits and retirement. And that leads to, the safer workplaces. There's a whole host of things, but it also is about a voice and having an ability to sort of discuss on more even terrain with your boss. And I think that's this combination of these financial benefits, but also the sort of voice and power and a feeling of being listened to, that is really what the unions can help deliver for workers, and why we are seeing this really significant resurgence in interest in unions. You mentioned at the top this. I'll let you go in. Sorry.
Well, I was actually going to say, so yes, sure, interest in unions, but there's been a deceleration in actual union participation. So why is that?
Yeah, this big difference. So right now, union support is the highest it's ever been. About 70% of the public support unions now, and half say they would like to join a union if they could. But unfortunately, the law for how workers form unions is really broken and weak, and it gives employers significant ability to pressure workers to not join a union. And if employers break the law, the penalties are very, very weak. So, for example, it's illegal to fire a worker for trying to form a union, but there's almost no financial penalty for doing so. So it happens with some regularity, which makes workers afraid to exercise their basic rights.
So, David, I want to talk about another potential strike on the horizon. Let's talk about UPS. That one is a bigger issue. We know negotiations between UPS and Teamsters seem to have hit a standstill. Well, they really have. There are only really less than 2 weeks left to avoid a strike, at which point over 300,000 workers could halt and cost the economy billions. Do we see some kind of solution there coming before that deadline?
There's always a chance. There's been negotiations for some time where the UPS and the unionized workers have agreed on many of the terms. They have, for example, agreed around air conditioning the trucks, so that because workers are really, as it gets hotter and hotter, workers really struggle in those trucks. But there's some major issues still remaining, especially around pay. And I think it's really going to be an open question. There's a big, big threat to the economy. There's hundreds of thousands of workers who would be laid off and lose their paychecks, but also UPS would lose, potentially billions of dollars, as well as all of the customers dependent upon UPS, including the businesses that depend on them to ship. So this is a big threat to the economy right now. But it's also in the short run, but it's also long run, I think, question of whether UPS workers feel this is a question of whether they can be paid fairly for all that they did for the company.
Uh-oh.
I think we've got a
little
problem
bit of a
with
glitch.
David's shot there.
I should be back.
David, we got you. Okay, we got you.
Yeah. So
yeah.
Go on.
It's interesting when we talk about this sort of disconnect that you mentioned before about the support for unions and the participation in unions. And I think about the Teamsters in particular, which historically has not always had the best of reputations, I think we can say, has had some management issues. So, how much do unions sort of need to look to themselves and not just externally to the rules that govern them to try to get more Americans on board?
There's, always the way that unions organize themselves and what they do and how they present themselves is, of course, crucially important. But the larger statistics I was telling you about, that this is largely about the law, is all unions, no matter who has been their leader, are largely struggling. They're facing the same decline across pretty much every industry. So it's hard to blame the particular union. Certainly, as you mentioned, Teamsters history was not particularly good in recent years, but they have a new leadership. And so the new leader has, I think, a greater incentive to really stand up for the workers and say, hey, we might not have cut the best deal last time, and we really want to make sure that workers benefit here, just as the company has had near record profits.
You know, David, as I look over the past couple of years and the wage gains that Americans have had, many of them have happened not because of union necessarily, but because of the workplace dynamic right now, the job market dynamic, just that there's a shortage of workers. How long and sustained do you think worker gains will be as we see the job market start to change?
Well, yeah, you mentioned, so full employment with unemployment near record lows, that really helps existing workers do better, that they're likely to have higher wages. And they have, especially in recent years. But whether that's going to continue, I think that's an open question. And that's why these sort of union questions are so important, is right now workers have power only when they really, really tight labor markets. But historically, they've had more power when you combine these tight labor markets with some sort of collective voice. And those two tend to lead the best results for workers.
All right, David Madlin, we will have to leave it there. Center for American Progress Senior Fellow and Senior Advisor at American Worker Project. Ahead, we're diving deeper into the drama heating up between UPS and the Teamsters Union. New York Times opinion writer Peter Coy and Stanford University Professor of Political Science and Center on Democracy, Margaret Levi, join our Jared Blickery in our next hour to discuss.
And Jared has you for the next hour of trading. Stay with us.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery, and here's what I am watching today. Big bank earnings paint a mixed picture for investors despite beating expectations, but are beats enough this time around? We break down what the signals mean for the remainder of the results season. And then retail sales show muted gains in the month of June, slowing down from May's pace. Despite signs of easing price pressure, we're going to get a pulse check on the state of the consumer. And a strike looms for UPS union workers as the deadline to reach a deal draws near. We're going to break down that battle with a panel of experts this hour. But first, let's take a quick look at the markets. And you can see it's a mixed market with the Nasdaq down just about 15 basis points. The S&P 500 up 1/3%, and the Dow up a whopping 328 points. And let's check in on the Treasury market as well, where we're seeing the 10-year T-note yield that is down about 3 basis points to 3.77%. All right, we got results from big, medium, and small banks this morning. It was a bit of a mixed bag for the stocks that are moving higher. And joining us now to break it all down is Yahoo Finance's David Hollerith. David, what are you noticing?
Hey, Jared. I think Bank of America, the second largest bank, sort of stands out first. What we saw from them is that global markets and investment banking, those two businesses sort of stole the show. They came in better than expected, and the bank's core revenue stream, net interest income, also rose 14% year over year. And though that came in slightly worse than expected, Bank of America still gave a rosier outlook for net interest income on the earnings call, looking towards the second half of this year. They said they expect to still be up 8% for the full year. So, going into this bank earnings season, I think a lot of analysts have sort of been saying there's been so many revisions. Sort of the conversation has been around, the people or the banks who do not revise their expectations are probably going to be the ones that look like winners of this season, which is sort of interesting, and it kind of gives you an idea of where we are now. Morgan Stanley's profits fell 12% from a year ago through the second quarter, and it turned out to be less bad than expected. And trading and investment banking both came in much lower, but slightly better than expected. And it also has a significantly larger wealth management business, which helps cushion its revenues a lot. This is kind of notable for Goldman Sachs, which is reporting earnings tomorrow, and they rely even more heavily on investment banking and trading, given that they have a smaller wealth management business. Charles Schwab also came in with earnings that did not look great, honestly. Their profits were down in net income, which fell 28%. Deposits were also down, falling 31%. That's both from a year ago. But importantly, Charles Schwab had issues in the first quarter related to its cash sorting, which was basically that depositors of the bank were moving to higher yielding accounts. And what they've seen in the last month or so has been that trend has been decelerating. And given that that's the main thing that investors have been paying attention to, that seems to be how the stock is responding. Back to Bank of America, I will just point out that even though they had incredible results, they are a good read through for the smaller banks. They increased deposit costs by $1.4 billion from the previous quarter. And that's notable as we're going to see results from smaller banks. Western Alliance is reporting this afternoon, and that's where we'll see sort of the theme of what we've been paying attention to in earnings, which is the rising deposit costs. We'll see how the smaller regionals will respond to that. And so we'll be paying attention for signs there. Obviously, Western Alliance faced some of the most scrutiny of any regional bank during the first quarter.
Yes, we're going to be talking about those rising deposit costs in just a second here. Thank you for those excellent points there, David Hollerith. And stocks are mixed as investors digest these bank earnings that we got before the bell. Expectations for results in the second quarter They've been low, with S&P 500 earnings expected to make the sharpest decline since looks like the second quarter of 2020. So are companies set to beat modest expectations? Joining me now is Keith Bliss. He is the BlocksCross Global Head of Markets and Strategy. Keith, thank you for being here today. Great to see you in our studio. As always, you were just listening to David go over some of the numbers here. Some of these regional banks, and I'll throw Charles Schwab in there, looking pretty good on the deposit side. You tell me, what's your takeaway from all these bank earnings?
Well, I think David hit the key point for me, which you're looking at the banks, all the banks, from the mega banks, the Bank of Americas, the Citigroups, the JP Morgans, all the way down to the smaller publicly traded community banks. And it's really about net interest income. If you take a look at one of the other banks that did report this morning before they opened, PNC Financial, one of the points that I gleaned from their press release is that their net interest income, which is roughly 66% of their top line revenue, did have its margin squeezed by about $75 million this quarter. And they cite a rise in the cost of attracting those cheap deposits. So what we're seeing is, and it's a natural evolution of capital markets, especially when you take a look at how tilted and inverted the yield curve is at this point in time. Deposits are the lifeblood for a bank. They borrow on the short end, they lend on the long end, and as those deposit costs come up, all things being equal on the long end of the curve or in their loan book, their margins are going to get squeezed. So I think that's a bit of a canary in coal mine we'll probably see play out in the next 2 quarters.
You think it's safe to say yet that we've turned the corner on the mini banking panic that we had just a few months ago, that these results are kind of verifying that things are going at least in the right direction?
Yeah, I mean, what happened at Silicon Valley Bank and some of the others, Signature Bank, was really a two-pronged story. Number one is that they got a flood of deposits coming in 2021. The market was, the capital markets globally were awash with capital, found its way into the banks. Banks have to do something with that capital. They can't just leave it sitting on the street and not earning any kind of income. So what they did is they put it in the places where they knew, which was longer dated treasury bonds. And then the other part of the story was the slow management moves, the mismanagement really of taking a look at how to size up their balance sheet, both assets and liabilities. And what they did is they mismanaged that. They were holding longer dated treasuries and they were held to maturity, which means that they didn't have to technically mark them to market every quarter. But some wise man woke up one day and said, hey, guess what? Silicon Valley Bank is technically insolvent here. And that just started a bank run on millions of deposits. So I think you're right. That story is largely played out. Banks are now under scrutiny to manage this a little bit. The FDIC has woken up to take a look at what's happening with some of these banks. So I don't think that's the problem. I think it's going to be more in the core franchise of banks, excuse me, both in deposits and lending.
All right, I want to pivot a little bit, and I just say a little bit because I'm going to talk about Bitcoin, crypto assets, and in a way, those are kind of levered to what the Fed is doing. I'm going to leave the segue aside here. Yeah. Bitcoin in price, it has managed to climb above 30,000, kind of got rejected there. It's looking better from a technical perspective, but you actually are the founder and one of the owners of BlocksCross. That's a crypto exchange. You tell me, what are you seeing on the ground?
Well, thanks for mentioning that. Yeah, we actually, if I could, a quick advertisement. Sure, yeah, we launched operations, and as part of the story, and I'll be short here. We launched operations back in October of 2022 in Colombia, which was going to be our primary market, and we were. The intent was to launch a retail market in Colombia, a pretty large addressable market, large crypto enthusiasts and crypto adoption down in there in Latin America. And then, of course, FTX happened. So we kind of had to pivot our business model a little bit, but we survived. So anyway, but more broadly to your question is that I think the way the market is going to shake out and the way we're gearing our business right now is you will have a couple of the tokens, a handful, not the 10,000 that we have out there today, but a handful that will trade and be used for investment vehicles, payment mechanisms, and savings vehicles, Bitcoin, Ethereum, maybe Litecoin, certainly the stable coins fall into that category. And I think what you're going to see then is that trade as commodities do, they're going to wax and wane on their price action depending upon what happens with economics, global monetary policy, similar to any other asset class that you take a look at. I think Bitcoin, though, is poised for a massive run-up because as we get some of the regulatory uncertainty cleared out, as well as when Bitcoin and Ethereum really start to gain even more traction than they already have as payment mechanisms, that's when the value of them will truly spike. Can't say when that's going to be, but right now I have that position.
I was reading Twitter over the weekend, Raoul Pal calling for a God candle if Bitcoin really breaches 30,000 to the upside. I haven't seen a God candle in forever, so I'm looking forward to that if it comes.
Yeah.
But let's talk about Ripple. Key court decision is actually kind of upsetting the way investors are thinking about the regulatory regime in a bullish way for crypto. Can you just go over your thoughts on this latest settlement, or not settlement, but decision?
Yeah, the decision was a bit of a, if I can borrow a French phrase, a bit of a come see, come saw for Ripple and the market overall, where they made the decision that Ripple does not pass the complete Howey test as it relates to retail consumers buying and selling it on the exchange. The upshot from that part of the decision really impacted companies like Coinbase, where Coinbase refused to delist XRP, Ripple, and allowed their customers to continue trading it. But then the second part of the decision was sales of XRP to the institutional community was deemed an illegal sale of unregistered securities. What it does for the company overall, though, is it may clear the way for U.S. institutions and U.S. banks to use it as the payment and remittance mechanism back and forth and across globally, which is already being done overseas, offshore the U.S. And really, it was devised to be a quicker, cheaper, smarter way to replace the old SWIFT system that is used by institutions to pass money back and forth. So I actually think even though it's not a complete victory for Ripple, it's not a complete defeat for the SEC, I think it's positive for Ripple's business practices, and certainly what we do in Latin America, and then as we have ambition to go globally, Ripple will be a part of how we convey products and services out to the clients.
Is it safe to say that the crypto winter, maybe both of them are finally over? What are you seeing on the ground?
Well, certainly this iteration of it. If you take a look at a lot of people forget that all assets go through boom and bust cycles. I mean, all you have to do is just take a look at U.S. equities since 1987 when I first got my first job.
It was when you started that they started getting volatile there. I know that.
Yeah, and the cycle started shortening.
Yep.
I think I definitely had something to do with that. But anyway. People need to realize that the Bitcoin white paper was written only in 2009. It seems like it was written 50 years ago, and people tried to figure out the digital currency and cryptocurrency enigma for a long time, and then Bitcoin was the first one that solved the double spend problem. Then we can talk about that on a later show, Bitcoin specifically. But anyway, I think it's likely that we see more cycles moving in and out of this. The only technology that you didn't really have multiple cycles of boom and bust was around the internet, because after the internet bust cycle, the dot-com bust happened, that's when the telecom companies really started investing in getting broadband into the house so that you wouldn't have another bust cycle inside of internet e-commerce companies.
And they overlaid the fiber cables, and that was a whole separate mess. But.
Exactly, and that allowed the internet, which basically runs everything in our lives now when you think about it, to succeed and grow and scale and thrive. When it comes to cryptocurrencies, I think where this goes is not necessarily you and me being able to invest $50 in a bunch of Satoshis and holding it. Yes, they'll be part of that because there is intrinsic value, especially as it becomes popular for a payment mechanism. Where this really goes is about money payments, movements, remittances, transfer of value around the globe very quickly, reduce friction, reduce costs, because right now it's still a very expensive way to do that, where anybody who's holding a mobile device in their hands, and we all have them, regardless of your socioeconomic status, can now participate in the global financial system. That was the goal and the mission of blockchain and digital assets from the very beginning, and we're starting to see that play out, certainly in the markets that we service down in Latin America. It's huge for moving payments and value around that area.
That's very encouraging, and it's great as always to get your insights here. Keith Bliss, Bloxcross Global Head of Markets and Strategy. Well, all your markets action ahead. Stay tuned. You are watching Yahoo Finance.
What sector is going to perform the best during earnings?
I think this market is ready to rotate, so I would look at things like financials, energy, perhaps industrials, and I think consumer is always one to watch. I think tech is going to do well, but I think this market is ready for something else to do well also.
Let's do a check of the market sponsored by Tasty Trade. And you can see it's still a mixed market, though the Nasdaq not down by very much, 22 points there. S&P 500 down up 1/3%, and the Dow is up almost 350 points, and that is good for 1%. Well, results season is in full swing, and Netflix is on deck to report after the bell tomorrow. It's the first major streamer to post numbers, and its ad tier and password sharing crackdown will be watched with laser focus. So, what should investors expect? Yahoo Finance's Ali Canal joins us now to help break it down. Alexandra, please.
Yes, Jared, and like you were mentioning, all of those revenue initiatives, everything Netflix has been doing is going to boost revenue and earnings in the second quarter. It's expected to be a strong one. Here are the numbers to look out for. Revenue expected to come in at $8.29 billion with adjusted earnings per share of $2.09. Subscriber estimates are for 1.85 million, although I've seen variations across the street with Wells Fargo anticipating subscriber net adds will be as high as 2.1 million. Another key number to watch will be average revenue per user. That's expected to see a boost as more subscribers sign up for that ad tier, along with some users utilizing that extra member fee for $8 a pop if you are a part of that password sharing crackdown, which you and I have been a part of that.
Yes, I got caught up, and guess what? I re-signed in about 2 days. It worked. Netflix, you got me.
Exactly, me too. And I think that's fueling a lot of the bullish sentiment that we've seen on Wall Street across the board. We have 29 buys, 25 holds, and just 3 sells. The stock is up more than 55% year to date. It's one of the top performers in the S&P. And I mentioned that strong third-party data, which we got at the end of this current quarter, analytics platform Antenna, showing that signups in the U.S. for Netflix jumped by the most in at least 4.5 years after the implementation of that password sharing crackdown. So clearly this is working. It's coming at a really solid time when competition is high. And then you have the overhang of the double strikes happening in Hollywood. But we've been talking to a lot of experts that say Netflix is best positioned to weather that storm due to the amount of content that they have and also their exposure to foreign content and more localized content overseas. So overall, it's going to be a strong report. I'm putting it out there.
Okay, I'll quote you on that, and we can quote you on that tomorrow afternoon.
Yes.
You're going to be breaking those numbers live for us.
After the bell.
All right, thank you for that, Ali. All right, there's been a new promising development in the treatment for Alzheimer's. New trial data on Eli Lilly's experimental drug found that it can reduce the progression of the disease by 36% in patients after 18 months. Let's bring in now Yahoo Finance's Anjali Kemlani to give us all the details. Anj.
Hey, Jared. Yep. New news from Lilly on their promising new drug, which will be competition for already out there Eisai and Biogen. We'll get to that in a second. So what did Lilly tell us? They told us that they saw a 36% decline in patients after 18 months, reduced cognitive decline in almost half of those patients. And they boasted one really interesting metric, which is 60% reduction in cognitive decline in their less severe Alzheimer's patients. They've already filed for approval and expect a word from the FDA later this year. But to set up this competitive market, or what will be a competitive market, we already know that this is coming on the heels of Biogen and Eisai getting that approval, that full traditional approval for Leqembi. So that drug on the market now will be competition for Lilly. Biogen and Eisai did have a slightly lower amount of cognitive decline in their phase 3 trials, 27%. So if you compare it to what that means in terms of slowing the progression of the disease, Lilly saying 7.5 months slower progression versus 5 months for Biogen and Eisai. And then the infusion time is also reduced. So Lilly's is just once a month instead of Biogen and Eisai's twice a month. Now, it's important to note that Biogen and Eisai are also looking at the injectable option as well as earlier stage patients, as well as multiple types of dosing. So they've got a lot on their plate to get into this market. But of course, promising news for what has been a pretty dormant area for quite some time.
Yes, and Anj, sticking with Big Pharma here, Pfizer has some interesting news out this morning. What can you tell us?
That's right. So Pfizer announced a partnership with Flagship Pioneering. If you remember, they're the backers of Moderna. And that partnership is going to target earlier stage potential acquisitions for Pfizer in a nutshell. So the terms of the agreement are that both are investing about $50 million each, so $100 million total for 10 programs. And Flagship can receive up to $700 million for milestones as well as royalties. And Pfizer can, like I said, acquire a potential target there. And the deal could be worth, some have said, up to $7 billion. So interesting one there. Of course, Flagship has had a number of other successful companies exit, but Jared, an interesting one if you think of it as more of a power move, of course, if you know the story of Pfizer and Moderna during the pandemic. So
Yes.
Really interesting move there on Pfizer's part. Earlier stage is a new trend in the big pharma industry because of the Inflation Reduction Act. So this could be also a play there for Pfizer.
Good to know. And thanks for breaking that all down for us, Anjali Khemlani. All your markets action is ahead. Stay tuned. You are watching Yahoo Finance.
Will the S&P 500 be higher or lower at the end of earnings season?
The end of earnings season, potentially higher. I think it's a tough call, but potentially higher.
Why?
Because I think there's been a lot of doom and gloom coming into this reporting season, and while I don't feel, super enthusiastic, I think the doom's been overstated.
With a little more than a week since the latest labor talks broke down, the contract issues between UPS and the Teamsters union are still at heads. Both sides blame each other, and the threat of workers walking off the job is still very much a threat. Last time this happened was in 1997. 16-day strike led to a 98% decline in operating profit, according to UPSEC filings. So let's bring in New York Times opinion writer Peter Coy and Stanford University professor of political science and Center on Democracy, Margaret Levy, to discuss more. Thank you both for being here today, number one. Margaret, let's begin with you. Can you just talk in broad strokes about what this is going to mean for the talks? And then, as I pointed out, this is a situation that really hasn't happened since 1997, far out of the public mind. What does this mean for UPS, the negotiations, and for these discussions?
Well, first of all, what the American public is now getting is a little bit of lesson in the way in which unions negotiate and the employers negotiate with them. We haven't had a lot of major union actions for some time in this country. So it's very hard to know what's going to happen in this, but I suspect that a lot of what is happening is signaling that each are really solidifying their position, and there's very likely to be another round at the bargaining table before an actual strike takes place. If the strike does happen, it's a big one, a really big one. There are 340,000 workers. This affects our logistics chain, our supply chain, how we get our packages. We're all incredibly dependent on that these days. There is an alternative, of course, two alternatives in delivery, FedEx and the Postal Service, neither of which would be striking. FedEx, both of them, because they're under a totally different set of regulations and rules, not necessarily because their workers feel that they're any better off.
Yes, important point there, and we can come back to that in a minute. Peter, first, I wanted to get your big picture thoughts on this, please.
Right. This is vital for both sides. As the professor mentioned, there are 340,000 Teamsters working for UPS. So they're absolutely indispensable to UPS's function. On the other hand, the UPS accounts for 1/3 of the members of the Teamsters. So the union needs the company to succeed as well. And a piece I wrote that came out just after the breakdown in negotiations for my newsletter in the opinion section of the New York Times said that it really would be a shame if there's a strike here because they've had a long and productive relationship. Teamsters Union goes back to 1903, UPS goes back to 1907, and they have had a mostly productive relationship ever since then, where the pay is relatively strong, the working conditions are relatively good versus, say, FedEx, for example, or for Amazon. And they're so close now. Several of the critical issues have been resolved. For example, refrigeration and other cooling methods in the trucks, which was a very legitimate bargaining condition for the Teamsters. They got that. Elimination of a second tier of pay for certain part-time worker drivers. They got rid of that. What remains now is negotiation over pay. And that has not been resolved. And the clock is ticking. I work for the opinion section, so I'm allowed to express an opinion. I'm not going to take sides in the talks, except I do think that it really would be a shame if they did not manage to reach a contract and we had a strike.
Fair enough. Won't hold you or force that. Margaret, you mentioned a couple minutes ago the organization. So FedEx is organized under a different set of laws than UPS. We can throw Amazon into the mix. People wonder, well, why not Amazon? Can you just kind of give us the lay of the land here with respect to how these things are shaped with respect to the law?
Well, there's a set of legal regulations that affect the right to engage in collective bargaining and the conditions under which unions can strike. And there are two principal sets, and they really have different rules. The one that affects UPS is the National Labor Relations Act, which was passed in the 1930s under Franklin Delano Roosevelt. and which is really, as is the Railway Act, which was passed even before that, and is what FedEx is under. They're both very decaying pieces of regulation. They were built for another era and another time, and yet they're what these unions have to, and the employers have to struggle with. But they are very different. So the Railway Act, which affects FedEx, does not permit this kind of bargaining and strike under these kinds of conditions. So FedEx keeps saying, look, we're so much better off because as an employer for you to deal with because our workers can't strike. On the other hand, their workers are much worse off in many, many ways, as Peter Coy just mentioned. And so it's very important that UPS and the Teamsters come together on this and continue the progress that they've made. One of the big things here that I really want to emphasize is this two-tier system that was introduced and has been introduced all over the place by employers, in which new workers are brought in under different and worse terms, worse payment, worse benefits. UPS has been better than most in how it has implemented that two-tier system, but the two-tier system has been a real stickler. And even though the negotiations have now somewhat ended it, there are still pieces of it that remain in place, and I do think that's part of what's holding up the bargaining as well as the wages.
Peter, in your article, the opinion article that you were just talking about, you say UPS strike would harm the company, the union, and the customers. You're very clear that this has wide-ranging implications. Given what Margaret was just saying, is it possible, do we just need new labor laws? Is that a potential solution here?
I want to go back to something Professor Levy said about the different treatment of the two unions or two companies. FedEx, for historical reasons, the express portion of their business is treated under the Railway Labor Act, which makes it hard to strike and also hard to organize, which is one reason that FedEx Express still not organized. UPS under the National Labor Relations Act, it's easier to organize. And yet the historical differences between the two companies have shrunk so that it kind of doesn't make sense anymore that they're treated differently. And that's been a sticking point for years for UPS, the management, saying, we feel that FedEx should be treated the same way we are. And when you talk about the harm of a strike, to me, it's analogous to the harm from a war. Two sides talks between them break down, they go to war. The war ends inconclusively, lots of suffering has occurred, and then you end up with a deal that could have been struck without a war. A strike can be the same way. The idea that one side is going to convincingly win the strike is just ridiculous. What will happen is we'll just have a strike, a lot of interruption to the economy, the workers' strike fund guaranteed to run out, the company will lose money, business will go to competitors such as UPS, and then a deal will eventually be struck with a lot more ill will and lasting damage to both sides. That's not that different from what could have been reached now before the strike deadline.
Margaret, can I say, though, that the threat of a strike is a very important tool?
I was going to give you the last word here, so please go.
Yeah, I mean, even though I agree with you, Peter, about the effects often, not always, but often of a strike, the threat is an incredibly important. What else do workers have? If they're organizing and have collective bargaining, then they have to be able to threaten to withdraw their work and have it be a credible threat. Otherwise, they have no bargaining power. And that's what's going on here.
Fair point.
All right, Peter, actually, we got one more minute. Any last word from you?
No, I think that Professor Levy just made an excellent point. And by saying what I said, I wasn't trying to say that the union shouldn't use whatever leverage it has. Both sides are appropriately using the leverage they have as we reach the final weeks. I guess what I'm saying is that let's hope that this game of chicken doesn't end up going off the cliff, that in fact they do soon, I hope, reach a contract. The problem is that the union has said that it won't do, it'll go on strike if there's not a completely ratified contract by then, and there's not time for that. So I hope that the union would say, okay, fine, we have a deal, even though it hasn't been completely ratified, we're not going to walk off the job until voting is completed.
I think there's been some change in that, Peter. I'm not sure. I think the union has agreed to
do. That's sensible, yeah.
All right. Well, I'd like to end here with everybody on the same page, and it looks like we're going to be white knuckling this down to the deadline. So thank you very much, New York Times opinion writer Peter Coy and Stanford University professor of political science and Center on Democracy, Margaret Levy.
Thank you.
Dangerous heat levels are growing in the United States, setting record highs. The southern part of the United States is expected to be engulfed this week with temperatures that blaze past 130 degrees Fahrenheit. As the planet warms and heat stays high, more consistent cooling is needed in homes, schools, offices, and hospitals. That's according to Climate Central, a nonprofit that researches and reports on climate change since 1970. Now, since 1970, 97% of locations in the United States have seen a rise in cooling degree days, and this is a metric used to show how much cooling is needed to maintain a comfortable indoor temperature. The Southwest, South, and Southeast regions of the United States, they have seen the largest increases. And Climate Central is projecting cooling degree days will drive a 71% increase in household cooling demand by 2050. Data from HVAC Insider, love that name there, is suggesting that shipments for central air conditioners and air source heat pumps is down 70.2% this year, year over year. And while shipments for air conditioners dropped 14.9% year over year, there are several key players in the market. AB Electrolux, Blue Star, and Daikin Industries, to name a few. But the air conditioning market is expected to grow by $19.6 billion by 2027, according to the latest research report from Technavio. 44% of the growth will come from the Asia-Pacific countries, and the compound annual growth rate is set to rise 2.87%. All your markets action right ahead. Stay tuned. You're watching Yahoo Finance.
Is there a magic word like AI was last quarter, this earnings season, or is it just going to be AI again?
I don't think it's going to be AI. I mean, I think we're going to hear a lot of that, but maybe not quite as much because there's some pushback about it being overhyped. I think it's going to be some economic word, something to do with consumers, something to do with demand, the state of the economy. I don't quite know what that word is going to be, but I think it may be something like stability or resilience.
Home builders still going strong. The National Association of Home Builders Index, it shows builder confidence rising for the 7th consecutive month. Yahoo Finance's Danny Romero joins us with more on the health of home building.
Jared, there's no stopping home builders. Confidence hit the highest level since June of last year, and that strength really reflects the new homes market as there's tight supply right now. That's really tipping the scale in favor of builders. Challenges, though, they still remain, those high mortgage rates as well as low inventory. And there's also been some supply chain issues, too, revolving around home appliances. All that aside, builders are confident that there will be more foot traffic in home buying. But again, mortgage rates are hovering around that 7%. So some of those home buyers are still sitting on the sideline. In some ways that builders have been able to entice some of that demand has been through those rate buy downs, also price cutting some of those homes. But regionally, builders are pretty confident in the Northeast, and home prices have been pretty high in that region.
I'm looking at the Wi-Fi Interactive at the year-to-date results for a lot of these home builders. Hovnanian in the upper left, that's up 160%. Beazer almost 130, KB 73%. So these are the builders. They're optimistic, but what about the other guys?
Well, with the tight supply out there, home prices are really selling above their asking price, about 2%. So really, other data is showing that the competition is fierce. There were 3 buyers for every 1 home that was selling on the market. So really,
I've heard these stories.
So it's happening. We're seeing it. And to give you some perspective, the number of homes that are being listed has dropped about 15%, really hitting an all-time low. So demand is there. Consumers are resilient and they're adapting to these higher mortgage rates. But I think that there are some overheated markets, of course, and there could be some cool down ahead.
Yeah. Seems like demand really trumping those high mortgage rates, almost non-existent, seemingly. So, Yahoo Finances, you had something to say. I could see it coming up.
Well, with the builders that are publicly traded, they have been offering incentives, which really look enticing for a home buyer, right? If the current mortgage rate is sitting at 7% and they're offering a rate buy down of about 5%, that's really going to entice someone to buy right now, Jared.
I did not know that, but thank you for adding that. Yahoo Finances' Danny Romero. PNC kicked off regional bank earnings this morning with a miss on revenue, but check out the stock action. Is this a sign of more things to come for the sector? Joining me now is Jay Woods, Freedom Capital Markets Chief Global Strategist. Jay, great to see you here. I'm looking at some of if we can go to the Wi-Fi Interactive, let's just show the regional banks that we have up here. This is only what's happening today. Green across the board, despite the PNC miss. And guess what? Here's a look at the last month. Now you take a look at the year-to-date, well, it turns red there, but is this saying maybe that PNC results showing that we've finally turned the corner here?
Yeah, we've been looking for some sort of all clear signal for a while, and as a technician, we follow price action, and there's nothing more telling right now than the price action we're seeing in PNC. The news was bad. They missed. And what did it do? It opened lower. It reverse filled that gap, and then it broke out above 130. Watch this 130 level. I mean, you use it as a stop if you're in the stock right now. If it can close above there today, it's got a lot to reverse, and that leads to the rest of the regional sector. We talk about the Keeper-Wet Woods index, the BKX. I always get that symbol wrong. I'm a little dyslexic on that one. But watch the 86 level on that. That is really indicative of what happened during the regional banking crisis that started in March. We haven't been able to really lift our head from that. We have a lot to reverse, and we're seeing it. Charles Schwab.
Yes.
There's a stock that just broke out above 60.
Up to its 200-day moving average.
Right to its 200-day moving, slightly above it as we speak. Price action is great, and there's a lot to reverse. So I'm watching a lot of these regionals right now, surprised with the action in PNC, but only price pays, and price right now is telling us we've reversed, something's going on, and they're shaking off this bad news. I'm looking at Comerica. Watch the $50 level there. Fifth Third, $28 level. They're touching it as we speak. U.S. Bank, 37.5. Key Bank, a lot to reverse. Watch 12. And then PacWest, that was one that was rumored to be going away for a little while. Still hanging strong, has a ways to go. But these are stocks, as you showed in your first heat map, going back a year, there's a lot to reverse. And in this kind of environment, people are chasing performance, and the laggards are picking up bids, and we're seeing it right now with the regionals.
Yeah, I mean, I was jokingly saying last week, well, we got all these meme stocks finally in favor again. That must be that the end is either here or just at the beginning of something that has swept up everybody in incredibly bullish momentum. I'm wondering about the latter, Jay, because we're seeing transports breaking out to the upside. The Dow Industrials are a little bit lagging, but let's talk some Dow Theory here.
Good old Dow Theory, the things that make and the things that take. When historically, and I know people are going to be like, yeah, but that was before tech. That was before, things have changed. But it has always proven true. If you're making new highs in the Dow Jones Industrial Average now, which we just hit a 52-week high live on air, we did that, and the transports at 52-week highs, they're both about 5 to 6% away from all-time highs. If both these indexes are making 52-week highs, all-time highs, that's as bullish as you can get. And over the next 12 months, this is not just going to be the top. Making new highs doesn't usually signify a top. It signifies a secular trend that is changing. And, we are in a technical bull market, 20% off the October 13th lows. But now we're seeing momentum switch into two of the sectors you want to see lead. And then if you look at the Dow, before today, I don't know where we are at this moment because things are doing so well, but 14 of the 16 components of that index were down year to date. So they have something to reverse, and there are two in particular, Amgen, United Healthcare. Technically, a lot of work to be done, but a lot to reverse. United Healthcare had a nice earnings report. It gapped higher. It's got some room to run just to get to its 200-day moving average. That is the biggest component in the Dow alone. That should take us higher.
Because of its price,
Because of its price-weighted index.
That's the way it is.
Tend to forget that.
Well, if we could, we got the Dow Jones Industrials heat map up, year-to-date results, and you can see more green than red, more dark green than dark red. So definitely bullish on that front. And let me just pull up another chart here. This is the Dow. You can see really big break to the upside here. And this is the industrials. This is kind of what I was waiting for today. That move yesterday, a little bit not convincing. But here's the industrials. Let me put this on a 2-year. Stick with me. Here we got the transports. Those broke up a few days ago. We got XLK up to record highs. We got home indices and ETFs at record highs. We got semiconductors at record highs. Industrials heading towards, if not at record highs, and then value. You put this all together, that's a lot. That's pretty broad-based, it would seem. Yeah,
and watch Russell. The Russell looks like it's on a march to 2,000. It still has room to go. Regional banks are definitely helping the Russell today. But new highs are not indicative. Forget the headlines. Forget what you're seeing right now. There is a momentum behind this rally. We do have seasonal headwinds to deal with. I don't think it's a straight shot to all-time highs in the Dow or the transports here.
Or the small caps.
No, we have a ways to go. But the momentum is clearly in favor of the bulls. There is a lot to reverse here. And what are people doing? They're rotating. And the rotation, the industrials say the XLI broke out 2-3 weeks ago, and the momentum continues. Now the Dow, I think that momentum should continue for a few more weeks. And who knows? Maybe next time I'm back, we will be talking all-time highs.
We got time for another one. Any tickers, any sectors you want to talk about that we didn't cover yet?
No, I mean, I think right now the story is in the regional banks. The industrials, they broke out 2-3 weeks ago. Watch Boeing. Boeing in that sector alone, yes, it's also in the Dow, but that has a lot to reverse. If Boeing can snap out of this little consolidation point, and it may be as we talk, because a lot of things have changed, Boeing, I think, could lead us on another leg higher if there was one individual stock within the industrial sector and the Spider Select sector, the XLI, that I think would be the tell. And then the transports, they continue to just impress. The cruise lines are having another fantastic day, even though there was a downgrade in Norwegian. So right now, the tide is literally lifting all the boats, and those beaten down sectors, people are rushing for it. You mentioned the memes. They look good. A lot of Cathie Wood names have based and broken out. ARK Fund.
It's about time. Yeah, I mean, you take a look at the most shorted, it might as well be the ARK component list right there. But things definitely turning up on so many different fronts. Jay Woods, always great to see you here. Appreciate you stopping by.
Great to be here.
All right, results season is fully upon us, and some would say earnings aren't driving this market. Are we going to find out? It's multiple expansion. Let's get to Jill Melendrino at the Nasdaq. Jill.
Hey, good morning. In the stock market, S&P 500 index, it's up 17% to date in earnings season. We are in the thick of it, or certainly getting close. A flood of soft inflation data has equity investors excited about a sustained rally, further extending already stretched PE multiples. The results on the surface probably won't offer much to write home about, given consensus estimates imply a 7% year-over-year decline in S&P 500 earnings. Since multiples are driving returns, valuation and guidance matters. Given the focus on whether or not the economy is poised for a recession later this year, there will be an inordinate focus on how companies characterize the behavior of their primary customer base, particularly consumer staples and discretionary businesses.
Well, let me ask you, because we've been talking about with Jay Woods just now about the broad-based rally, seeing more sectors participating. So what is the sector outlook, Jill?
From a sector perspective, the energy sector is projected to detract the most from earnings growth, with consensus estimates showing a 48% decline in profits amid the significant drop in oil prices over the last year. Conversely, the consumer discretionary and communication sectors are the only two sectors projected to record double-digit earnings growth, 27% and 13% respectively.
All right, we want to talk some econ data. Retail sales taking a back seat today amidst earnings rolling in. But let me ask you, is this still a key report? The results today, I think for June, were up 0.2%. That's just barely keeping pace with inflation. Does it still matter?
Of course, it still matters because the consumer really has been the bright spot in the economy. Recall that 70% of GDP is made up from consumer. Retail sales, to your point, they came in at 0.2%. That was versus consensus of a 0.5% increase. This can be interpreted in a couple of ways. It's probably good news if you want a steady slowdown in demand that can lead to lower inflation. At the same time, May was revised up. The control group, which strips out things like gas, autos, building materials, was strong, pointing to some continued momentum, but we're not seeing consumers spend like crazy across the board, at least according to the overall numbers.
All right, we got to leave it there, but thank you as always, Jill Malandrino over at the Nasdaq. Our trending ticker of the hour is Schwab, which just reported a beat on earnings, as well as some stats on banking deposits. Well, they fell 7% in the second quarter from the prior period, 31% from a year ago, but not as feared, not as bad as feared. Total client assets swelled to just over $8 trillion, up 17%. Now, the discount broker and bank sees full-year revenue shrinking 7 to 8% year over year, but investors are liking the wind down of borrowings from the Federal Home Loan Bank, and it's down 10% sequentially. That's quarter over quarter. All in all, it's enough to boost the stock price by double digits today, and that is the most since the dark days of the pandemic in early 2020. Let's do a final check of the markets here, and we can see that it looks like everything is still up. There we go. The Nasdaq finally joining the party, so everything in the green now, up 0.2%. S&P 500 up 0.5%, and the Dow is up 1%. Thank you. We'll see you later.
Have you tried out Threads? Do you believe that Threads is going to be the Twitter killer?
You know, I'm not sure if it's going to be the Twitter killer, but will definitely be some competition. I have an account on Instagram. I use Instagram. So yes, I did the Threads app, but in all honesty, I haven't gone through and looked at anything on there yet. Maybe it's a weekend activity. We'll see. But right now, I don't think it's stiff competition for Twitter.
All right, drop the @ for the team here, and we'll hit you with a few fresh follows on IG.
Perfect.